Cases drop, but a study warns Beijing risks a tsunami of infections if it abandons COVID-0. Plus, European gas supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. Prices jump.
Just a few seconds to go then, Tom, until the start of the European equity trading session, and futures have been pointing higher. Futures have been suggesting that we will continue to see some movement higher, really making the most of the gains that we saw on Wall Street and into the Asia session. You wonder how sustainable those gains are, though.
Yeah, absolutely. As we look ahead to the CPI print out of the US and whether or not that gives us more detail in terms of the rate trajectory then for the Fed, and if indeed we are reaching peak inflation, as Anna was suggesting then, you did see some gains on Wall Street overnight for the S&P 500 and the Nasdaq, not completely making up for the heavy losses we saw on Monday, of course, but the Nasdaq ending up around 1.3%. So the read across, and as well the tailwinds from China, where there is a bit of relief that has set in around the fact that those COVID-0, or at least COVID cases, have started to come off a little bit. So the open, you're seeing some gains of around 1% on the CAC 40 over in France, an uptick of about 56 points on that index. The FTSE 100 gaining 0.4%. We had the Queen's speech done by Prince Charles yesterday outlining some of the policy priorities for the UK government. The Spanish IBEX up 0.5%. And of course, we continue to watch the implications of the gas price move. It was a 5% move yesterday, increases again today on the back of those disruptions that have been flagged out of Ukraine. Let's move on and see how things are playing out then across other assets. We wanted to highlight for you the moves that were fairly substantial when it comes to technology listed in Hong Kong. At one point, gaining around 6%, come off now, about 3% gains. We have seen this. We've ridden this rodeo before when it comes to the uptick and then the sell-off when it comes to Hong Kong tech stocks, or at least Chinese companies listed in Hong Kong. We'll continue to watch that space. Again, part of that, a relief move, it seems, by investors there. Futures with the Nasdaq looking to add on to the gains that we saw yesterday. Around 0.5% is the gain we're seeing on those futures. And the 10-year yield at 2.95, so below that 3% level, yields coming off a little bit. A bit of a move into US Treasuries, currently at 2.95. Brent, that is up 2.5%. Continue to watch the oil space. The interlinks, of course, between gas and oil, 105 on Brent. Anna.
Yeah, we've ridden this rodeo before, Tom says, and it certainly feels that way when you look at the risk-on way that we're approaching this session this morning. We see healthcare stocks, the biggest area of red really on this IMAP, so on this assessment of the sector breakdown across European stocks. So we're selling healthcare stocks and we're buying pretty much everything else, aren't we? We've got consumer discretionary perhaps flashing the brightest green, suggesting most appetite there. So that's what we're seeing in terms of the big pictures, in terms of the sector breakdown. Tom, what do you see in the movers?
So in some of the individual names, we're waiting for some pricing on Bayer and ThyssenKrupp. It was a beat when it comes to the top line with earnings for ThyssenKrupp and raising their guidance as well. Things like steel products, of course, they're seeing strong demand for that and so far coping with the inflationary costs. So it was a beat on the top line for ThyssenKrupp. Bayer, there was some news out overnight that the Biden administration had in fact recommended that the Supreme Court push back against their appeal, and that could open the company up to some litigation, particularly around California, amid concerns, allegations that, of course, that Roundup weed killer is linked to cancer. So watching that stock as well. Allianz, it hit there when it comes to the additional set aside it's had to put in around the blow up, the implosion of its hedge fund in the US, around $2 billion on top of the almost $4 billion that it outlined for us earlier in the year, currently gaining 1.6%. So not too much concern, it seems, from investors on the back of that news from Allianz. But a big drop, there you go, for Bayer, down 7.5%. And again there, decent gain for ThyssenKrupp, up 4% just in the first few seconds. Let's get to Bloomberg MLive Managing Editor Mark Cudmore now for more on these market moves. Mark, you're looking at what happens if, and this seems to be the market pricing, well, in fact, the market pricing as US inflation starts to peak. You're looking at what happens if US inflation starts to beat.
Yeah, I think we're particularly vulnerable with today's US inflation print. If we get an upside beat, we're particularly vulnerable for nominal yields to really surge and therefore much more pain across risk assets. Here is a chart of US real yields in the 5-year and 10-year sector over the last 15 years. The white line is 5-year, the blue line is 10-year. And you can basically see this incredible surge recently has only been replicated twice in the last 15 years. That was during the 2013 taper tantrum and again in 2008 during the financial crisis. So what we've seen here is 5-year yields are finally on the verge of going positive. Minus 5 basis points now. They're minus 1.7% only 2 months ago. So it's really just in quite an incredible turn. Now, what's particularly interesting is the last couple of weeks, the move up in yields has slightly stalled. It's not pulled back, but it's not gone much further. Why has real yields continued to increase? Well, that's because break-even inflation expectations have plummeted recently, fallen by 70 basis points in just the last 2.5 weeks, 30 basis points in just 2 sessions. A really, really credible move down in inflation expectations. That shows that traders are buying into the idea that the peak of inflation in the US was seen, and therefore, yes, we're going to have elevated inflation. Yes, we might have too sticky inflation, but we're no longer going to be the inflation spiral. And because traders have bought into that narrative, that means if inflation does beat expectations significantly today, we'll really get a massive shock in nominal yields, and that will cause an intense bout of pain across risk assets generally.
Okay, the vulnerability of these markets to any inflation print that comes in above expectations. Thank you for breaking that down for us, Bloomberg MLive Managing Editor Mark Cudmore. Now, ahead of today's inflation print, US Fed governors have said that they have faith in their current course of action, even if it leads to a brief recession.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me.
We have a labor market that's so hot, so overstimulated that it's a market where you could pull back a lot of demand for labor and it would actually be a good thing.
Trying to bring inflation down in that context is going to be hard to do without a brief recession. I'm not forecasting anything like 2008.
50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively.
It's not a situation that calls for an emergency type of move.
Do we need to go above neutral? And that's what I think we're going to learn a lot more about over the next several months.
At this point, I don't care what the reasons are. Inflation's too high, and my job is to get it down.
Some of the thoughts of the Fed there. Let us get into a market conversation now, the impact of this latest Fed thinking. Let's talk about that with Kiran Ganesh, who joins us, multi-asset strategist at UBS Global Wealth Management. So, Kiran, really nice to see you here in studio with us. If we get, and we've heard a couple of Fed officials talking about that maybe it's right to think about 50 basis points in June, 50 basis points in July. Can stocks keep rallying if that's what or can they turn around and convince us more, I suppose, with this mini rally we're seeing, if we see 50 basis points in both of those months, do you think?
I think the 50 basis points is fine. I think what's really going to be key is the inflation print today, because if that can come in lower sequentially over the 2 months, then we're going to move the market debate away from this question of is the Fed going to get more aggressive, is the Fed going to get more aggressive, which we hear 75 getting talked about. If we can move on to an environment where we say, okay, the Fed's projected path is enough to get inflation under control, then we can start to move on to a debate about, okay, well, what's the economic impact? What are stocks looking like in the aftermath of this? Perhaps yields come under more control. So I think that's going to be really the key, just shifting that debate away from, is the Fed going to get more aggressive, to, okay, we're set, what does it mean?
And Kieran, if that CPI print comes in line with the expectations then and softens from the previous month, you start then to position for a recession, given you say that the focus then would be on the economic impacts.
I mean, our base case is that we will see this softish landing that the Fed is talking about, so that we will see clearly a slowdown in growth, but growth will remain positive. I think in terms of positioning, if we do get that softish landing and the Fed's current path is sufficient, then all risky assets are likely to rally. But where we're positioning is, okay, well, how can we be wrong here? one way we can be wrong is that inflation remains more persistent. So we like commodities, we like value. Both of those should do well if inflation stays more persistent. We also like healthcare and quality, which should do quite well if we do see a sharper slowdown in growth. So we think that by combining a strategic allocation into stocks and bonds, but also being tactically oriented to some of those areas where we might be wrong, we can help navigate some of this uncertainty and volatility.
And where do you see as the best protections against inflation at this point, Kieran? Because we've talked with many guests about commodities, but commodities have rallied a lot already and have been popular as an inflation hedge. And there are some voices talking about how commodities might not maintain their current levels, and even some base metals have started to fall already. So what role does commodities play?
So certainly as an inflation hedge, we think that they work well. Clearly, if we do enter a recession, then things like base metals are at risk. But in the context of a portfolio, we think having some commodities in there makes sense. And we actually also like the US dollar at the moment in respect to an inflation hedge, because if the Fed is starting to get more aggressive, 75 basis points, at the same time as the European Central Bank is still doing relatively little, despite quite high inflation in the Eurozone, we think that the dollar can keep appreciating in an inflationary environment. And as I mentioned, value stocks, historically, inflation above 3%, they've tended to outperform. So we think that's a good place to be today at the moment as well.
Kieran, what do you do with, I'm a little bit concerned because you hear commodities, you hear healthcare, you hear the US dollar, and if you're just starting to look at the markets now for whatever reason, then those are calls that have been made for a number of months. And I wonder what the window is in terms of the opportunity then to position within those assets, and whether there is, just to build on Anna's question, more room to go, how narrow that window is.
Well, I think it just comes down to that framework I laid out earlier, that if we can move on from the debate about, has inflation peaked, how aggressive is the Fed going to get, then maybe we move on to more of a debate around growth, and then that maybe shifts some of the preferences a bit, and then perhaps we start to get more clarity on that through the summer, and then we'll maybe get into debates about, what's the secular outlook, what does it all mean? So I think as we move through those different stages, that's when these windows will shift, but for the moment, we've still got a lot of uncertainty about inflation and growth and the secular outlook, so we think that this positioning in defensives, value, commodities makes sense.
Okay, Kieran, stay with us. Kieran Ganesh, multi-asset strategist at UBS Global Wealth Management. He stays with us longer on this program. And coming up, we will continue to talk about global growth because we'll focus in on China. Cases ease in Shanghai, but China's zero COVID policy comes under criticism, under attack from the WHO. We'll have more on that next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We are 13 minutes into the European trading day this Wednesday as we look ahead to the CPI numbers out of the US. The markets here in Europe pushing, in fact, up 0.5% across your benchmark. The future stateside S&P E-mini is looking at gains of 0.3%. You've got every sector bar 3 here in Europe in the green at this point, led by consumer real estate and technology. 3 in the red are healthcare, chemicals and personal products. As that's the shape of play, 30 minutes into your trading session. But we're going to get more on China now, Anna.
Yeah, absolutely. That's European markets. Let's get to the engine of growth that is China. Shanghai has reported a 51% drop in new coronavirus infections, with 0 cases found to have spread within the community. For more, we're joined by Bloomberg's Michelle Cortez. Michelle, cases declining then. Does this mean we're nearing the end of the outbreak in Shanghai and maybe in Greater China itself? That clearly seems to be the short-term thought process that's driving risk assets higher, but you wonder how long-term that lasts.
Well, we are in fact looking at coming to the end of the outbreak in Shanghai. Certainly, we know that the curbs that they've put in place there has mitigated some of the infections, but many people, millions of people, have been in lockdown for almost 6 weeks in Shanghai, and we know that these outbreaks last about 6 weeks in general everywhere in the world. So the challenge for Shanghai is going to be to get actually back down to 0. That will be a challenge. They're going to have to ramp up what they're doing in order to wring out those last little trains of transmission. But we did get some good news today where they did see 0 community infections. That means that all of the cases that they have found were in people who were already in quarantine, already tagged as being potentially high risk. So that gives them some reassurance that they're not seeing the virus continue to spread in areas where it could be doing damage that they're not aware of.
Yeah, we heard earlier in the week from Premier Li Keqiang urging companies to kind of step up production. Are we seeing that? Are we seeing any impact, at least easing those supply chain constraints and a tick up in production?
We are absolutely seeing increase in production and activity happening in Shanghai and in other places, often because they've moved to these kind of closed loop circles, which allow their workers to stay inside the loop, and much like we saw with the Beijing Olympics, keeping those workers safe from the virus and keeping those plants and facilities running. Of course, the challenge is we don't know how actively they're running. Are they running at 100%? Are they running at 10%? We have seen, many companies have been disclosing in their earnings reports that these lockdowns have been hurting their production. And as that continues over the next couple of weeks here, we're going to be getting more insight on that as well.
Okay, Bloomberg's Michelle Cortez, thank you for updating us on the situation in China, where those COVID cases have started to come off, particularly in Shanghai. Still with us is Kieran Ganesh, multi-asset strategist at UBS Global Wealth Management. We heard earlier, we were speaking to the team from Brewin Dolphin, and they said if we'd asked them a couple of weeks ago, they would have said we're still bearish, essentially, on China. Now they're starting to change their views. They think a lot of this is already priced in. Do you align with that view? How do you look at China?
Yeah, so we think if we're looking at the markets globally, and as I said earlier, looking for markets which are cheap, looking for markets which are going to see more stimulus rather than less stimulus, then China certainly ticks those boxes. So we've been talking quite actively with clients about how to make sure they can build up a strategic allocation to the country and use this time to build up those longer term allocations. Now, of course, in the short term, there's lots of questions about the COVID-0 policy, the effect on growth, the lockdowns, what's the end game there. So we'd expect to see quite high volatility in the near term, but we still think as a longer term play, when we look at the valuations and the potential path over the medium to long term, it makes sense to have some investment in China.
Makes sense to have some investments in China, Kieran, but this must be a China that is unable to play quite the same role as it did globally for as long as it has COVID-0 policies that mean that people can't flow freely between China and other parts of the world. I wonder what kind of downward pressure that puts on either Chinese growth or global growth, in fact.
Yeah, well, clearly, I mean, we're talking about Chinese growth with a 4 handle on it, and historically we were talking 6 or 7%. So it is, clearly quite a different proposition. But I think we can see how far the markets have come down. It's now just 3 to 4% of the MSCI All Country World Index, which is pretty small considering the size of the economy. So we think that allocating at those kind of levels will give investors a chance to diversify and grow their portfolios over the longer term.
Okay, Kieran Ganesh, multi-asset strategist at UBS Global Wealth Management. Thank you for those insights. Maybe increase your allocations around China for the longer term, at least. Coming up, Fed's Loretta Mester. We've got some tape. We've got an interview, Anna.
Yeah, absolutely. Loretta Mester saying that she favours a half-point interest rate hike, but is open to bigger increases if needed, keeping that 75 conversation alive a little. We have more from that interview next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. We are 21 minutes into European trading day. Gains across the benchmark of 0.6%. Futures in the US pointing to gains as well. The Nasdaq futures up by 0.6%. Let's switch gears back to the Fed, and Cleveland President Loretta Mester said she favors half-point interest rate hikes, but she says she would support bigger increases later. That's if inflation doesn't ease by the second half of the year. She spoke exclusively with Bloomberg's Mike McKee.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. We're going to have to assess whether inflation is actually moving down, and then we'll be able to get more information after we do a couple of those to see. Both supply and demand are going to be moving over time. So, you know, the aim is we need to use our tools to do what we can to get demand in better alignment with that constrained supply. And so I don't want to rule anything out. When we get to that point in the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, you know, we might be predicting, then we can adjust at that point. But I do think that we need to be very committed to being resolute in doing what we can with our tools to get inflation down. And that's both the balance sheet, which, you know, we've announced that'll start in June, and also with the policy rate.
Well, your colleague John Williams said today he expects unemployment to rise because that's what you do when you raise interest rates. Are you on board with that? Would you warn people, yes, unemployment's going to rise, the economy's going to slow because we need to do that?
Look, we have excess demand in both product markets and in labor markets. So we can raise the interest rate or policy rate and slow that excess demand. But, you know, this is not going to be smooth. There's going to be bumps, and the unemployment rate may have to rise. We may get another quarter of or two of negative growth, but that has to happen in order to get inflation down. So we are tightening financial conditions, and we're going to continue doing that until we see inflation moving back down to our 2% goal.
Well, you get 2 quarters of negative growth, and that's the R word that Fed officials don't like to use.
Yeah. Well, I guess that's a rule of thumb, but it really is going to be like how much is demand slowing? You know, if you look at what happened in the first quarter, there was a negative read on GDP, but if you look at what's happening in the consumer spending side of that report and on the business side of that report, those were quite strong. There's a lot of demand momentum in that report. Yes, government spending went down. Trade, of course, was a big negative for growth in the first quarter. And also that inventory, you know, which had surged in the fourth quarter, there was still a high level of inventory investment, just not as high as in the fourth quarter. So again, I think it's always good to look under the hood of those reports. And we may see some of that happening over time. But again, you know, our goal is to bring inflation under control, have it start moving down towards 2%, and sustain healthy labor markets. I don't really see this as a trade-off right now. You know, in order to make sure that labor markets are sustainably healthy and that we can sustain getting to maximum employment, we need to get inflation under control.
Well, if you get inflation down to where is acceptable, and then what happens? Have we changed inflation dynamics and an inflation regime?
Right. Well, we're aiming for our long-run goal of 2%. Now, if the question is, will it take some time to get down to that level? Yes, because we know that inflation can be persistent and certainly we have supply constraints that, even though everyone hoped that they would be easing, are not easing, and there's upward risk to inflation. So it will take some time. I don't expect we're going to get inflation down to 2% this year or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy.
Cleveland Fed President Loretta Mester keeping 75 basis points on the table there. Let's check in on some of the individual movers. And there's been a sharp leg lower for Bayer after the administration of President Joe Biden recommended that the Supreme Court throw out a California appeal that could open them up to more lawsuits. And certainly investors not liking that news, down at 6.5%, Anna.
Another stock that is weaker is Roche, the drugs company, down by 4.9% this hour. And this all to do with a drug called Skyscraper 01. It's in trials, and it's missed some of its targets, essentially. It's missed some of its endpoints, and that is being met by a disappointment from some analysts. So, for example, Vontobel analysts calling this a major disappointment.
Allianz also coming out and saying that they are going to be setting aside another approximately $2 billion US in regard to the implosion of the hedge fund business in the United States, building on that almost $4 billion US that they announced earlier this year. It may seem counterintuitive that the stock is up 1.8%. Maybe this is about the fact that Allianz seems to be at least moving on from the implications of this.
Yeah.
So setting aside money, of course, they expect further litigation.
Yeah, and they had said previously that there might be more write-downs to come, so that maybe that's in the mix as well. Coming up on the programme, gas clash. European supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. We saw gas prices jump a little on this story. We'll get analysis next. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear It wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. 30 minutes into the European trading day. Here are your top stories. Cleveland Fed President Loretta Mester says the FOMC may need to hike by 75 basis points if inflation does not subside. US CPI data is due out today. Chinese stocks jump as coronavirus cases drop, but a study warns Beijing risks a, quote, tsunami of infections if it abandons the COVID-0 policy. Plus, European gas supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. Prices have jumped. So, Tom, European equity markets then making some gains this morning. Early stages, I suppose. Feels like we're still bouncing a little from the losses that have been. A bit of a roller coaster in terms of stock markets and risk appetite over the last couple of days.
Yeah, roller coaster to say the least. Mark Cudmore, of course, from our MLive team, suggesting that the markets are gearing up for this inflation print, the CPI print, to come in lower than the previous month. And if that doesn't happen, if it comes above the estimates, then you could see some volatility return to these markets, already volatile markets, of course. You see very modest gains, currently of 0.2% across the benchmark. A similar picture for the DAX, the FTSE 100, also up 15 points, 0.2%. Again, as we look ahead to the CPI, we weigh up what we heard from Loretta Mester, keeping 75 basis points on the table. And then the tailwinds from some relief in China. We saw a solid session on the mainland over there. Consumer products leading the pack, up 2%, followed by auto parts and technology. So some of the riskier parts of the markets gaining in the session today. When it comes to healthcare, that has been one of the calls from a number, including Kieran previously of UBS, suggesting that that is a defensive play, but currently down 1%. So that is how things are shaping up. Just 30 minutes into Wednesday's trading session, again, as we keep a firm eye on that CPI data out around midday UK time in the US. Anna.
Okay, so that's the upbeat picture we see for the moment across European stocks. We'll wait for that inflation print later. Now, the EU has drafted a $205 billion plan to wean the continent off its dependency on Russian energy. It comes as Russian gas flowing via one of two key Ukrainian entry points will stop from Wednesday. In fact, it's already stopped this morning, we understand, as occupying forces disrupt operations. Joining us now is Bloomberg senior reporter for international affairs, Mark Champion. Mark, good morning. So do we know if Ukraine is cutting off the gas by choice or because something's happened? Can they just not guarantee the safety of that pipeline if they don't actually occupy that territory?
Yeah, I mean, good question. And fundamentally, we don't know. The Ukrainians have said that it's force majeure. The Russians have said they haven't had any evidence of that. And the Ukrainians also are relatively vague about what exactly the force majeure is. And in their statement, they suggest that, one of the issues is that they cannot guarantee security of supply because they don't control the territory. They do have some motivations to do that, to cut the supply. They are pushing Europe to stop buying gas from Russia. And at the same time, this is a pipeline that goes through occupied territory, raises questions for the future. They have another pipeline that doesn't, so it can also send a message. So there's a couple of things going on there. And, that really for Europe, what they're trying to do, every time this happens, you reduce the supply from Russia, whether it's gas or it's oil, price goes up. Russia actually gets, some more money. Sometimes it actually gets more money than it would have without the cut. So the move that the EU is making now to really sort of boost renewables and move away from gas means that you don't have to substitute gas and therefore push up the price. So, they're trying to cut that loop, really, that echo.
What's the broader impact? We're talking about prices. They were up yesterday, they're up again today, of course, on the back of this news. But the broader impact as these disputes really unfold in Ukraine between the Ukrainians and the Russians.
Yeah, absolutely. I mean, we already had, as we know, a gas price crisis before this war began. And the war's come on the back of that. It's pushed up prices further. It's made them fairly volatile. So, how we come out of it is a little unclear. Europe has said that they won't open a Nord Stream 2, which is a new pipeline that could have, brought gas from Russia. Here you have a war which is, right on the territory where most of the gas crosses, and we're beginning to see, the potential impact on that. I mean, in some ways, it's a surprise that there hasn't been any disruption till now.
Well, indeed, given the state of the conflict between the two countries, the invasion by Russia, of course, that the gas supplies have continued. Thank you, Mark Champion, for getting us up to speed, our senior reporter for international affairs. We'll get more on what is happening in Ukraine now, and more analysis on the situation with Leslie Vinjamuri, who is the director of the US and Americas program at Chatham House. Leslie, what do we know at this stage about Russia's attempts to cut Ukraine off, whether it's the soft commodities that, of course, Ukraine is so famous for and essential, but also when it comes to energy supplies as well? Is this part of a concerted plan by Vladimir Putin to cut Ukraine off from these markets?
Well, I think yes. And I think what we're seeing right now is that Russia is really trying to test the resolve not only of Ukraine and Ukrainians, but also of the United States, of Europe. We heard from DNI Avril Haines yesterday that the U.S. intelligence expects that this war will continue for a very long time, that there's no real possibility for a negotiated settlement in sight, and that in fact what we may well see from Russia is escalation, that this war won't likely be contained to the Donbass. So we're in for a long haul, a war of attrition. I think many people have known that, but this anticipation, I think, by the U.S. intelligence community that there will in fact be escalation at a time, in the U.S. context where we're seeing those primaries, we're seeing Donald Trump, endorsing candidates, where we're seeing inflation, gas prices rising. The question of America's resolve is certainly one to watch, despite what we saw yesterday, which is the House passing that spending package of $40 billion to support Ukraine. Something that, these are numbers that we're now starting to get used to, but they really are truly extraordinary.
Okay. Yeah, it's interesting to see, what we're talking about here in terms of the flow of gas through Ukraine. The first time that this war has actually affected the physical gas supplies, which is worth noting. Let me ask you about the support for giving further aid to Ukraine, Leslie, that you referenced in the United States. This has been pretty bipartisan. I'm guessing it remains so. Update us on whether there are any cracks in that bipartisan approach.
It is bipartisan. We did see several, the votes against yesterday, which were small, were all Republican. There's always the potential that as this drags on, that there is division. Right now, it looks to be strongly bipartisan, and that's largely because the American public is still very supportive. But wars of attrition are difficult. They're potentially very long. America's entering a political cycle with the midterm of the primaries and the midterm elections in November. And that impact of inflation, I think, is going to be difficult to stomach. But we have seen the American people, the Republican Party, the Democrats, everybody really on side assisting Ukraine with that very clear red line, right? No escalation, no direct engagement by NATO. But I think, what we saw again from Avril Haines yesterday was preparing the American public that this isn't going to go away. It's going to be long, and that it's likely to escalate, that Russia's likely to escalate its efforts.
And Leslie, we've reported on the concerns of the US President Joe Biden that there isn't an obvious mechanism, an obvious way for Vladimir Putin to walk back from this without facing potentially some comeuppance within Russia and the body politic of Russia. Are we seeing any outlines? We know that Mario Draghi was meeting with the US President yesterday as well, and he's keen to put in place some kind of framework to move diplomacy forward. What could that look like?
And this is the question that everybody wants to know the answer to, whether there would be a moment where the United States and Europe would encourage Zelensky to accept some sort of giving of territory in the Donbass or in Crimea to Russia. That is not where Zelensky is right now. President Zelensky has made it very clear what his aims are. The United States is not there right now. And Putin's not there right now. He has more ambitious aims. So there's really no sign from any of the direct or indirect parties to this war of a plausible and realistic settlement. And in fact, what we're seeing is language, whether it's pushing, fairly on the grotesque and destructive and awful atrocities that have been committed, pushing for accountability and war crimes of Putin and those around him. These are all measures that make it much harder, of course, to imagine how there will be some sort of settlement, but there's really no sign right now that that's where this conflict is, tragically for all those involved.
Leslie, thanks very much. Leslie Vinjamuri, Director of the US and Americas Program at Chatham House. Thank you very much for joining us.
Okay, coming up, we speak with Continental's CFO as the German tyre giant reports first quarter numbers. We'll be talking about margins, supply chains, the China impact. That interview is next. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Open. We are 42 minutes into your European trading day. Gains of around 0.3%, just ebbing somewhat from the open. Futures in the US, the S&P E-mini is looking at gains of 0.2%. The Nasdaq futures posting gains currently at 0.5% as we continue, of course, to look ahead to that CPI print out of the US. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The US House has approved more than $40 billion in an emergency Ukraine spending bill that will pay for new weapons and provide economic and humanitarian assistance. The package is significantly larger than the $33 billion President Biden requested last month. The bill heads to the Senate, where approval is likely next week. China's inflation has exceeded forecasts as COVID lockdowns battered supply chains and pushed people to stockpile food. Producer prices rose 8% from a year earlier. Consumer price growth accelerated to 2.1% in the year to April from 1.5% in the previous month. Statisticians blamed virus outbreaks and higher global commodity prices for the gains, which were faster than economists' projections for 1.8%. And it's the end of the road for the iPod, the groundbreaking device that upended the music industry more than 2 decades ago. Apple says it's discontinuing the iPod Touch, the most recent version of a product line that first went on sale back in October 2001. The last devices will remain in shops until supplies run out. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Anna. Laura, thank you very much. I remember those back in the day when I was an early adopter. Right, Laura, right, with your first Web News update. Let's get back to the earnings story this morning. First quarter results for the German tyre giant Continental are out, and it has confirmed its annual outlook given last month. But the company warned of major challenges due to Russia's invasion of Ukraine, a shortage of semiconductors, and rising supply chain costs. Some of the challenges we've talked about frequently. And let's get back to that conversation now. The CFO of Continental joins us, Katja Dürfeld. Very nice to speak to you, Katja. Let me start with the subject of pricing. We understand, hearing from lots of car companies, that they can put up prices, they can pivot towards more expensive brands, essentially, and they can try and increase their pricing and seem to have some pricing power. How are you doing in negotiating contracts to make sure that you also have some pricing power?
Yeah, good morning, and Tom, thank you for having me here. Yeah, we've as announced, we are in current negotiations and very constructive negotiations, in fact, with all our customers worldwide, trying to mitigate the impacts that we have on our production costs overall, trying to find solutions that help us in total to carry the burden that we are all facing at this point in time.
What is the room then at Continental to raise prices to kind of offset some of these input costs? How much are you looking at in terms of that space, the ability to pass that on?
Yeah, Tom, that really depends. You know that we are active in different customer segments worldwide, and that we are also supplying a quite broad range of products, a very diversified product portfolio overall. And it really depends on the channels that we're talking about. But as said, we are really trying to limit the impact that we have on us as a company, and we are in negotiations with all our customers worldwide, no matter where or in which customer segment we are.
You've also flagged some supply chain issues today. Where specifically, Katja, are those supply chain issues hurting the business? And can you do anything about any of them? Are there mitigating actions you can take?
Yeah, definitely, Anna. So it's the two major areas where we're currently affected is on the one hand still the semiconductor part. So the semiconductor supply chains have been very tight, not only this year but also the year before, as you are fully aware. And we've already initiated a program last year to really trying to mitigate the effects that we have on our supply chain. And this program has multiple layers. It's about increasing visibility. It's about improved risk management, and it also comes with increased safety stocks in the one or the other area where we've identified really critical components. And on the other side, our supply chains are also currently affected by the Ukraine war. You know that we do procure also some Aalberts products, and those are currently under heavy pressure, and we're trying to find alternative sourcing. We're looking for second sources to really mitigate the impacts that we have at this point in time, and we've done that quite well, I have to say.
Okay, so that's the supply chain impact. You touched on Ukraine, and part of the story for us today is the gas impact. And I just wanted to get some clarity from you as to how much exposure Continental has to gas, how reliant you are on Russian gas, and what you think would happen to the broader auto sector in Germany if those gas flows from Russia were to end.
What I can really not exactly say is how all the other market participants are affected by the gas supplies story. What we do have in Continental, we do use natural gas in different arenas. So on the one hand, we use it for pure heating. On the one hand, we use it for processing. And on the third side, we do have it also in the direct production program. And really, depending on the exposure the different locations have, there are different mitigating measures at this point in time that we are implementing to limit the exposure and also the impact that something like that, would have to us, especially. Yeah, and in general, I can say that we do have a normal supply mix in gas here that is common in Germany at this point in time. Yeah, but we are trying to limit the impacts.
trying to limit the impact. Katia, let me ask you about the long-term goals of the business. I appreciate that there's so much short-term uncertainty. It might be difficult in some cases to plan. But as we transition away from internal combustion engines towards electric vehicles for the car space as a whole, what kind of impact would you expect this to have on the margins at Continental? If we look out to 2030, 2035, when some of this regulation comes in across Europe, what impact would you expect that to have had?
Well, the first thing is that we have limited our exposure to the combustion engines by the spin-off of Vitesco Technologies last year. So that is something where we've already taken care. And most of our current product portfolio that we are now growing, our growth areas, are not depending on the powertrain itself anymore. So if we talk about interiors, if we talk about the digital architecture and the digital network in the car, if we talk about autonomous mobility, this does not depend on the engine and the powertrain anymore.
Okay, Katia Duerfeld, CFO at Continental, thank you for joining us. Continental, the company, of course, confirming its outlook, but of course pointing to those continued supply chain concerns. Coming up, could Donald Trump be about to make a comeback on Twitter? He just might. That's if Elon Musk takes control of the social media giant. The details are up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the European Market Open. 53 minutes into the European trading session, and European stocks are gaining, perhaps not by as much as the futures had suggested, up by 0.8%, for example, on the CAC 40, but making gains after some gains in yesterday's session as well. Now, traders are the most skeptical they've ever been about whether Elon Musk will actually complete his proposed purchase of Twitter. How do we get to that conclusion? Well, Twitter shares ended Tuesday at $47.26, while Musk has offered to buy the social media platform for $54.20. Meanwhile, Elon Musk says he would reverse former President Donald Trump's permanent ban from Twitter once he takes control of the company. Joining us now with analysis, Bloomberg Quick Takes, Alex Webb, who's with us. Alex, why are people starting to doubt then question, or continuing to doubt, increasingly doubting, maybe, whether this deal will actually go through. That's what that price discrepancy kind of tells us.
Well, partly because Elon said it himself. At this conference yesterday, he said that, well, maybe I won't bring Donald Trump back to the platform because maybe I won't end up being able to buy Twitter. Clearly, we don't know that he has all the financing in place just yet. There are regulatory hurdles too, perhaps less of a concern than the financing piece. So, you combine those three factors together and you have this huge spread between, as you said, the $47 price at which the shares closed yesterday and the $54.20 of the bid.
Okay, the financing concerns, the regulatory hurdles, and the comments of Musk himself. Talking of which, you mentioned the FT event that he was at yesterday. So we wanted to, of course, get some clarity on what his plans are ultimately for the platform, because he does take it over. Listen in then to what he had to say at that event about this question.
He has publicly stated that he will not be coming back to Twitter, and that he will only be on Truth Social. And this is the point that I'm trying to make, which is perhaps not getting across, is that banning Trump from Twitter didn't end Trump's voice. It will amplify it among the right. And this is why it is morally wrong and flat out stupid.
Okay, Musk there, flat out stupid to ban the former US President Donald Trump from the platform Twitter, saying that he would allow him to be back on the platform if indeed he does go ahead and buy it. What has the reaction been to this comment then from Musk?
I mean, there's certainly a certain amount of criticism of Elon Musk's logic, that if he's on this other platform, his voice is somehow amplified among the right. Well, there is an argument that the way social media works is that, and the perils of social media are such that you have people who are maybe centrist, center-right, or center-left, and because of the bubbles of content they get funneled into, they get dragged and actually sort of radicalized towards either extremity of the left or right. So if you have Trump on a mainstream platform like Twitter, it actually serves to drag people further, make people's opinions more extreme. Therefore, there is an argument to say, well, yes, actually do let him be in Truth Social, because a lot of the people in that space are already sort of his acolytes, his believers, and the effect is less perilous. So there are some people picking up on those comments and saying the logic doesn't quite hold.
And in terms of it's a bit of a false comparison, isn't it? Truth Social versus Twitter in terms of the reach of these two platforms.
Absolutely, and the fact is that Trump has barely posted anything on Truth Social. In fact, one of the complaints about it is that he barely has. The logic that Trump has said, well, I won't, well, Elon's sort of contradicting himself a bit there, because he says Trump says he won't come back, but it's also bad that Trump's on this thing. He should be back. Do we trust Donald Trump to say when I won't come back to Twitter that will be the case? Okay. Clearly, there are times where he's gone back on his word on various things, so it's hard to know.
All right, watch this space. Thank you. Bloomberg Quick Takes Alex Webb there.
Okay, that's it for this hour of the programme. That's it for the European Market Open. Surveillance Early Edition is up next. Tom staying with you for that one. A lot of sectors, 2/3 of sectors really in positive territory here in Europe. US futures also point higher. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement? to help reduce the emissions from these well-stocked maritime behemoths.
Our economy has gone from being on the mend to on the move. But I know that families all across America are hurting because of inflation.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. If we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, you know, we might be predicting, then we can adjust.
I would reverse the perma ban. Obviously, I don't own Twitter yet, so this is not like a thing that will definitely happen, because what if I don't own Twitter?
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's program. Cleveland Fed President Loretta Mester says the FOMC may need to hike by 75 basis points if inflation does not subside. US CPI is out today. Chinese stocks jump as coronavirus cases drop, but a study warns Beijing risks a tsunami of infections if it abandons COVID-0. Plus, European gas supplies are threatened after Ukraine says Russian pipeline throws through the nation could be disrupted. Okay, let's check in on these markets. The gains we're seeing slightly modest in the session, not quite as bullish as the optimism had suggested in the lead up, with the futures pointing to more solid gains that have actually materialized. But still, across the European stocks and the benchmark, you're seeing gains of 0.4%. Of course, we are looking to that CPI print, and our team, the MLive team and Mark Cudmore, have pointed out that the markets are pricing in, it seems, an inflation that is starting to peak. So if you do get a CPI number that comes in above estimates, you could see further bruising for these markets. The technology sector is gaining 1.5%. We've seen a move into treasuries. Yields have come off in a fairly pronounced way in the morning, in the session today. The Bloomberg Dollar Index providing some relief as well for some of those cross currencies. Down 0.2, almost 0.3%. Bitcoin remains in focus given the almost 50% drop that we've seen since about November of last year. Currently trading at 30,561. So just hovering above that 30,000 level, down 1.5%. Let's move on and see how things are playing out across the map here then in Europe. We continue, of course, to weigh up the geopolitics and the news that Ukraine has cut off at least part of their gas supplies from Russia. That dispute then pushing gas prices up once again, and then the ripple across to the broader commodity space. You're seeing gains of 0.6% here in the UK. The CAC 40 is one of the outperformers in terms of the major indexes here in Europe, gaining at 0.9%. Over in Germany, the DAX up 0.3%. We've had earnings as well that have come through from the likes of Roche and Continental. So just building out the picture, and of course the focus continuing to be on margins and pricing power that these companies have or do not have. Talking of which, inflation. Ahead of today's inflation print, US Fed governors and presidents have said that they have faith still in their current course of action, even if it leads to a brief recession.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me.
We have a labor market that's so hot, so overstimulated that it's a market where you could pull back a lot of demand for labor, and it would actually be a good thing.
Trying to bring inflation down in that context is going to be hard to do without a brief recession. I'm not forecasting anything like 2008.
50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively.
It's not a situation that calls for an emergency type of move.
Do we need to go above neutral? And that's what I think we're going to learn a lot more about over the next several months.
At this point, I don't care what the reasons are. Inflation's too high, and my job is to get it down.
Okay, let's get into these markets then. Joining me now is Bloomberg's markets editor, Eddie van der Walt, and also Ed Smith, CIO at Rathbones. Eddie, let's start with you and how you're assessing the commentary we've heard from some of these officials, particularly Loretta Messa, keeping 75 basis points on the table, wise, arguably, ahead of this CPI print later today.
You know, there's so much riding on this CPI print today. On the one hand, you know, we want to see whether the numbers are starting to come down. But then again, are they coming down too much? The market seems to be calling, you know, for a top, saying that this month will probably be a little bit less hot than last month, coming down to something like 8.1 from 8.5 or 8.3 last month. And, you know, but it all of that will just really inform the Fed in terms of how much they can do, because I think really the Fed would like to do more, but they're not sure whether they can, because they realize that they're pulling back on the brakes a little bit. And you're seeing things like the participation rate in the US, which isn't peaking up despite you know, a hot labor market, and the Fed's asking itself, you know, what if we do too much? So, you know, there's an awful lot riding on this print today.
Ed Smith, let's bring you in at this point. Is inflation, has it peaked? Are you seeing evidence of that? Do you need to wait for today's CPI to build out that view?
I think, well, one data point doesn't make a trend, and I think, unfortunately, we're going to have to wait for another 2 or 3 prints before we can really see that catalyst for a market turnaround from peak inflation that many strategists, including ourselves, are predicting. But we think that our base case is that inflation is going to fade back down to target by the second half of 2023. Yet we're seeing consumers prioritize spending on hospitality and travel, cutting back on spending on supply-constrained consumer goods that they spent an outsized amount on over the last 2 years, and that's important for inflation coming back down, coupled with we've got sky-high retail inventories, easing domestic logistical bottlenecks. We should see core goods inflation fall back from 12% in the first quarter to around about 0 by the end of the year. There's risks around services inflation for sure, but we think the fall in goods inflation will offset it.
Eddie van der Walt, let's bring you back in at this point. A little bit of optimism that we've seen in the markets, still not making up for the rout that we saw on Monday. What are you seeing in terms of positioning around CPI and around the reassessment of this rate outlook from the Fed and other central banks?
You know, yeah, I think the CPI has been so hard to call. Ed makes a really good point that there's a lot of transitory effects that will start to fade. You know, really should have started to feed through even now, but it's been really hard to call because inflation has beaten expectations almost month after month, and you know that's made it really hard for the market to position. And what we've actually seen is that something like the dollar, which you would expect to rise on a hot print in previous months, you know, because it just fuels the narrative that the Fed is going to hike quicker. In fact, what we've seen is the dollar has faded in the hour or so after the CPI print comes in. I think we're in for a volatile day, and I think it's going to take a little while for the markets to fully interpret whatever the print is. If it comes in hot, if it comes in cold, you know, I think the market's going to take at least an hour or so to really shake out and work through all the permutations of what that means for Fed policy. So I think we're seeing lower volumes. We're seeing, you know, a very cautious market in the run up to it.
Interesting. Hold on to your hats. The Bloomberg dollar in is currently down 0.2%. A move into Treasuries, yields lower on the US 10-year by 5 basis points, currently at 2.93. Bloomberg's Eddie van der Walt, of course, from MLife, and Ed Smith, co-CI at Rathbone, stays with us. We'll be talking China and other market implications just in the next few minutes. Just to recap some lines, talking about inflation, the central banks, Christine Lagarde, of course, of the ECB, giving some clarity on her views on how things unfold from here, saying that inflation inflation is likely to remain high for some time. It's unlikely, Christine Lagarde says, that disinflationary dynamics of the past will return, and she says it's appropriate for policy to return to normal settings. Euro-dollar, as you can see, currently up 0.2%. Inflation outlook is increasingly on target over the medium term, says Christine Lagarde. She also says inflation expectations currently are at or above 2%. That's pretty clear. But again, inflation outlook over the medium term, she says, increasingly on target. The ECB rate hike, she says, may follow just weeks after the end of bond buys. So this is Christine Lagarde, of course, at the head of the ECB, just giving her views, assessment of the inflationary outlook and what that may mean for a return to normal policy from Europe's central bank. We'll get more and bring that to you if and when we get more lines crossing from Madame Lagarde. In the meantime, coming up, cases easing in Shanghai, but China's COVID-0 policy comes under criticism from the WHO. We've got more on that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is a Bloomberg Surveillance early edition. We're listening in to the head of the European Central Bank, Christine Lagarde, giving her views on the inflation outlook for the Eurozone. Let's listen in.
Flexibility. The ECB's response, announcing outright monetary transactions, OMT, which was the monetary expression of the now famous whatever it takes, underlined its commitment to its mandate by reacting flexibly to the circumstances. This aimed at ensuring the effective transmission to the euro systems of its monetary policy with a view to maintaining price stability. In parallel, the response from Europe's leaders underscored also their commitment to the euro by launching the banking union plan, including in particular banking supervision and resolution. And this was probably the most significant transfer of authority and powers to the European level since the creation of the euro. And I'm delighted to salute Andrea Enria, who is head of the SSM, who is with us today. But the length and depth of the crisis left deep scars on the euro area economy. and set the stage for a long phase of too low inflation to emerge as a result. The double hit of the great financial crisis and the sovereign debt crisis left behind a persistent shortfall in demand and employment. From the onset of the great financial crisis, it took 7 years for the euro area GDP to return to its pre-crisis level and almost 12 years for unemployment to do the same. In Slovenia, those figures were 9 and 11 years respectively. Better. This environment that I have just described dragged down.
Okay, Madame Lagarde there, of course, the President of the ECB, just recapping, going back through the recent history of the European Central Bank, previously having said that normalisation, of course, should happen. It's appropriate for policy to return to normal settings. Also on inflation, saying that inflation is likely to remain high for some time, saying that net asset purchases should end in early 3Q or third quarter, and also saying that what we may see in terms of the rate hikes, they may follow weeks, she says, after the end of bond buys. Of course, some debate amongst market participants of whether the rate hike happens in June or July. We'll keep across those lines if anything else crosses for you. Currently, euro-dollar trading higher by 0.3%. And some moves into German bunds, just by 1 basis point lower on the yields there. The Italian BTPs, in terms of the 2-year, lower by 4 basis points. Let's get back to what's happening in China then. Shanghai reporting a 51% drop in new coronavirus infections, with 0 cases found to have spread within the community. For more, we are joined by Bloomberg's Michelle Cortez. Michelle, cases then declining. Does this mean we are finally nearing the end of this outbreak in Shanghai and those very rigid restrictions that have been put in place in China's financial beating heart?
We are absolutely nearing the end of the outbreak in Shanghai. The question is going to be at this point, how much more effort is going to be taken, is going to be needed in order to get back down to the 0 level, which is what China has consistently said that it's going for. Certainly, they want to make sure that they don't have any chains of transmission that are happening anywhere in the country. Now, investors are very excited because there is so much demand, and we want a lot of innovation and production coming out of Shanghai and other parts of China. But if the authorities do want to continue to wring out any last transmission, it could be another couple of weeks or even longer in order to make sure that we are truly back to 0.
Okay, Bloomberg's Michelle Cortez, thank you for the update in terms of the COVID situation in China. Ed Smith, co-CIO at Rathbones, still with us, waiting patiently. Ed, when it comes to the question of China, we've had BlackRock removing their bullish call on assets, or at least equities in China. We had a different view earlier this morning from the likes of Brewin Dolphin and UBS. They think maybe there's some opportunity there. Do we need to start, do investors need to start positioning maybe for a fiscal impulse out of China once and if they get this under control?
Well, we've been negative on China since early 2021, which back then was a pretty contrarian call. We continuously argued against the many strategists that turned more bullish over the last 6 months. And we are still maintaining our negative stance. The threats posed by the zero COVID policy is one. Another reason was we still think there could be an underestimation of the slowdown in property transaction and starts. Residential property transactions in the 7 mega cities have fallen below 2020 COVID levels. We don't want to catch that falling knife. Tight financial conditions. Yeah, there are some targeted easing measures. More and more of that is being announced, but we don't see it enough to really lift that credit impulse. We don't see the fiscal policy being enough to lift that impulse either. And that's really the key to Asia and Chinese markets outperforming the rest of the world. And look at something like, I just punched in Alibaba's bond yields onto the terminal. It's doubled in the last 6 months, right? Piecemeal stimulus is not enough.
Piecemeal stimulus, and arguably that is what is going to be coming down the pipe, according to many China watchers. Ed, you're more broadly constructive, though, on equities. You're staying invested. You think there's only a 30% chance of recession, but you have switched to more defensive sectors. Where does that take you?
Yeah, that's right. So, I mean, we've got a sort of 3-pronged approach to navigating the inflation and stagflation risks. But as you said, our base case is not recession, and corrections only turn into pernicious bear markets when you've got a global recession. But our three-pronged strategy is we want high-quality balance sheets, cash flow statements with high and stable margins, that sort of thing, clear pricing power. We've rotated more away from, we've ditched a lot of cyclicality over the last few months and rotated more into defensive sectors as well. There are some attractive valuations in quality growth names now. We're not shunning growth entirely, but we want to balance that up with value stocks. That's the second prong to our strategy, with earnings or valuations that benefit from higher inflation, higher commodity prices, or higher rates. And then finally, we also want a good chunk of our assets in sort of thematic investments, stocks with structural, acyclical investments to hedge against the risk of a period of stagnant growth. So we like stocks in cloud computing or greening the construction industry, that sort of thing.
Okay, a three-pronged strategy in these uncertain times. Just a 30% risk of a recession is the call from Rathbones' Ed Smith. And the top line, just pulling out of your notes, Ed, before we let you go, the start of a tightening cycle is not the time to sell equities. But clearly, as you say, you're moving more defensive and coming out of some of those cyclicals. We always appreciate the insights, Ed. We'll have to get you back on, have more time with you in the next few weeks. Ed Smith, co-CIO at Rathbones, thank you. Coming up, Elon Musk says he'll overturn Twitter's ban on Donald Trump. We'll get the details next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back. Another story we are watching today is Elon Musk's deal to buy Twitter. He says he would reverse the ban on former President Donald Trump if he takes control.
He has publicly stated that he will not be coming back to Twitter and that he will only be on Truth Social. And this is the point that I'm trying to make, which is perhaps not getting across, is that banning Trump from Twitter didn't end Trump's voice. It will amplify it among the right. And this is why it is morally wrong and flat out stupid.
What's with that picture? You'd have thought a billionaire would be able to have decent kit to get a nice picture. Anyway, we've also had some news on Musk's funding for the deal. Apollo Global is said to be in talks to lead the financing for the buyout. Joining us now for more is Alex Webb from Bloomberg Quick Take. Let's start then with the question about the former US President Donald Trump. It's not a huge surprise. That was the, we assumed, position of Elon Musk before this, before he made it clear that that's what he would do, he'd on board again the former president. What is being read into this? How are people reacting?
I mean, he's sort of tying himself in knots a little bit with the logic. He's saying, well, it's free speech and therefore we should have him on, and actually it's dangerous that he's on this other platform, but then he's not going to come to Twitter, he's going to stay on that other platform now. That assumes you believe Donald Trump when he says he won't come back to Twitter, which is perhaps quite a big assumption. Truth Social, he's barely posted, Donald Trump has barely posted anything on Truth Social. In fact, one of the complaints that the existing users have is that he's barely on there. But there's also an argument that has been made that actually having him in a sort of bubble of, you know, his supporters means that he's not dragging people out of the center and towards his views, which may be, you know, controversial to a lot of people.
And just very briefly, it seems that some investors at least are losing faith that Musk is eventually going to take this company over.
Well, not least because Musk himself has said he's not sure that he's going to be able to take the company over. And he said that as a reason maybe why Donald Trump wouldn't end up back on the platform. The spread is now for $7. 47 is where the share price is, 54 is the offer.
Alex Webb, thank you very much for the latest on Elon Musk's efforts to take over Twitter. That is Alex Webb from Quick Take. Coming up, the UK economy in focus as we put the pandemic largely behind us. Don't miss our interview with NatWest CEO Alison Rose. That is next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back. Cleveland Fed President Loretta Mester says the FOMC may need to hike by 75 basis points if inflation does not subside. US CPI is out today. Chinese stocks jump as coronavirus cases drop, but a study warns Beijing risks a tsunami of infections if it abandons COVID-0. Plus, European gas supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. The markets, by the way, here in Europe pointing to gains of 0.8%. That's what we've got so far on the European markets. Turned around, slightly more positive than just 30 minutes or so ago. And you've had a move into treasuries. Yields there are lower. Future stateside pointing to gains of between 0.7 and 0.9%. Now, few leaders in finance have a better read on the state of the UK economy than NatWest CEO Alison Rose. She spoke to Bloomberg for the latest episode of Leaders Live Blackwire and offered in-depth perspective on how she sees the post-COVID recovery.
We're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Do you feel more stress than at the beginning of COVID? It's very different. I mean, some customers will be able to pass on, of course, some of this inflation onwards, but then you'll have, a lot of families going through quite a lot.
Yeah, it's very different, and I think it's the experience is very different everywhere. At the moment, we're not seeing signs of stress in what we would see in our data around distress or loans or people asking for requests for help. So it's mainly concerns. But with fuel price rising, for the lower income families, it is quite distressing. At the other end of the scale, you've got a huge amount of liquidity sitting in the economy, on corporate balance sheets, in businesses, from all the quantitative easing that's been done. So you've got a number of things, pulling against each other, which makes it very complex. So I think it's really an important time actually for banks, again, to be really important because we can provide practical help and support to people.
So what kind of questions do you get?
I mean, it varies. We get a lot of questions from business owners about how they manage disruption to supply chain, how they can fund their working capital, how they can restructure their pricing mechanisms for families. It's how can they save money, in terms of the money they're spending to afford the increase in fuel prices that are coming. And we do something called a financial health check, where invariably we can save people money by bringing their finances together. So it's that proactive conversation.
That was NatWest CEO Alison Rose speaking to Bloomberg's Francine Lacqua, and you can catch that whole interview. That's at 6:30 p.m. London time on Thursday evening, right here on Bloomberg TV. Okay, let's get to your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. Philip Morris has agreed to buy smokeless tobacco company Swedish Match in a $16 billion transaction as it pushes beyond cigarettes. The offer from the maker of Marlboro is at a premium of nearly 40% to Match's closing price on Monday. The board of directors at the Stockholm-based company, whose vision statement is a world without cigarettes, said shareholders should accept the offer. Now, Apollo Global Management is said to be in talks to lead a preferred financing for Elon Musk's Twitter buyout. The funding, arranged by Morgan Stanley, will exceed $1 billion and may also include Sixth Street Partners, among other firms. Shares of Twitter did close lower yesterday as traders grow more skeptical that Musk will complete the purchase at the $54.20 offer price. Bloomberg has learned JP Morgan's uninvestable call on China was never meant to see the light of day. Sources say the firm's editorial staff did ask to remove the word from dozens of reports before they were actually published in March, but the label still made it onto 4, including one on JD.com that helped to raise about $200 billion from US and Asian markets. And Coinbase has tumbled and extended trading after revenues missed estimates. The largest US cryptocurrency exchange, which earns a bulk of its sales from trading fees, warned trading volumes in the current quarter will be lower than the first. Coinbase's shares have fallen to record lows, down more than 70% since it did go public a year ago. And that's your Bloomberg Business Flash. Tom.
Okay, Leanne, thank you. Now, Cleveland Fed President Loretta Mester said she favors half-point interest rate hikes, but she says she would support bigger increases later. That's if inflation does not ease by the second half of the year. She spoke exclusively with Bloomberg's Mike McKee.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. We're going to have to assess whether inflation is actually moving down, and then we'll be able to get more information after we do a couple of those to see. Both supply and demand are going to be moving over time. So, you know, the aim is we need to use our tools to do what we can to get demand in better alignment with that constrained supply. And so I don't want to rule anything out. When we get to that point in the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, you know, we might be predicting, then we can adjust at that point. But I do think that we need to be very committed to being resolute in doing what we can with our tools to get inflation down. And that's both the balance sheet, which, you know, we've announced that'll start in June, and also with the policy rate.
Well, your colleague John Williams said today he expects unemployment to rise because that's what you do when you raise interest rates. Are you on board with that? Would you warn people, yes, unemployment's going to rise, the economy's going to slow because we need to do that?
Look, we have excess demand in both product markets and in labor markets. So we can raise the interest rate or policy rate and slow that excess demand. But, you know, this is not going to be smooth. There's going to be bumps. And the unemployment rate may have to rise. We may get another quarter of or two of negative growth, but that has to happen in order to get inflation down. So we are tightening financial conditions, and we've got to continue doing that until we see inflation moving back down to our 2% goal.
Well, you get 2 quarters of negative growth, and that's the R word that Fed officials don't like to use.
Yeah. Well, I guess that's a rule of thumb, but it really is going to be like how much is demand slowing? You know, if you look at what happened in the first quarter, there was a negative read on GDP, but if you look at what's happening in the consumer spending side of that report and on the business side of that report, those were quite strong. There's a lot of demand momentum in that report. Yes, government spending went down. Trade, of course, was a big negative for growth in the first quarter. And also that inventory, you know, which had surged in the fourth quarter, there was still a high level of inventory investment, just not as high as in the fourth quarter. So again, I think it's always good to look under the hood of those reports. And we may see some of that happening over time. But again, you know, our goal is to bring inflation under control, have it start moving down towards 2%, and sustain healthy labor markets. I don't really see this as a trade-off right now. You know, in order to make sure that labor markets are sustainably healthy and that we can sustain getting to maximum employment, we need to get inflation under control.
Well, if you get inflation down to where is acceptable, and then what happens? Have we changed inflation dynamics and an inflation regime?
Right. Well, we're aiming for our long-run goal of 2%. Now, if the question is, will it take some time to get down to that level? Yes, because we know that inflation can be persistent and we have supply constraints that, even though everyone hoped that they would be easing, are not easing, and there's upward risk to inflation. So it will take some time. I don't expect we're going to get inflation down to 2% this year or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy.
Okay, Cleveland Fed President Loretta Mester there flagging 2 additional 50 basis point hikes and keeping the table, or at least on the table, the optionality of 75 basis points, at least in the second half. Coming up, gas clash. European supplies are threatened after Ukraine says Russian pipeline flows through the nation could be disrupted. We'll get analysis on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, the EU has drafted a $205 billion plan to wean the continent off its dependency on Russian energy. It comes as Russian gas flowing via one of the 2 key main Ukrainian entry points has been halted as occupying forces disrupt operations. For more, we are joined by Bloomberg's senior reporter for international affairs, Mark Champion. Mark, how is Europe going to deal then with Ukraine cutting this gas route?
Right. I mean, this will have an impact. We don't yet know how much gas the Russians will be able to reroute. The Russians say that it's technically impossible for them to reroute at all. We will find out. But for Europe, every time this kind of disruption happens, the price of gas goes up. They have to go source it elsewhere. And we already, of course, had a very elevated price, environment even before the war began. So, what the Europeans are really trying to do now is to sort of cut that loop so that they can, if they can really boost quickly the amount of renewable energy that's being produced, then they don't have to rely so much on further gas and oil supplies in order to replace what they're getting from Russia, so that they can kind of escape that. But there is a difficulty there in that it takes time to develop those new sources of energy, whereas the war is happening right now. It's going to be a sort of a difficult play. And what you can see, it's not quite clear. The Ukrainians say that what happened is that there was a force majeure, that that the occupying forces were making it impossible for them to move the gas. But they were fairly vague about that. And the fact is that the Ukrainians do have a motivation, whatever the actual facts of the matter were, but they do have a motivation to cut the gas, to reduce the gas supplies, and basically reduce the revenues that Russia's getting.
Mark, what does this episode tell us about how the war is unfolding in a region I know you have visited?
Well, we're really moving into a war that's going to take some time, a war of attrition. It's grinding and ugly, and likely quite long. So the focus increasingly is on logistics and on supply lines. This is one example. Russia blowing up refineries. Russia blowing up refineries is another, which they've been doing recently in Ukraine. And when I was down just recently in the southern region, which is a very, very quiet region down just south of Odessa, that's become a big transit route now that the ports around Odessa are closed. And the Russians have several times hit the bridge that is really the only direct road link through Ukraine to get out to the EU from there and take all the grain and other cargoes that haven't been able to get out of Odessa.
Okay, severing some of those ties. Mark Champion, thank you. A busy man, clearly, with many phone calls coming through. I hope you get back to those. A man in demand for your expertise. Thank you. We appreciate the time. Now we are joined by Arisia Lutsevich, who is the head of the Ukraine Forum in the Russia and Eurasia program at Chatham House. Arisia, thank you for joining us this morning. On some levels, it's very surprising that Russian gas flows continue through Ukraine. But of course, for the parties involved, there is a rationale here. How stark, how salient is the risk now that Russian gas through Ukraine will ultimately be cut off?
Well, I think we have to keep in mind that Russia was always trying to bypass Ukraine, directly rerouting its gas through Nord Stream 1 and Nord Stream 2 that has now been sanctioned. And what Russia wants to show is that Ukraine is not a reliable route for Europe. It's not a reliable partner. At the same time, Ukraine has exactly opposite objective, trying to show that despite the war, Ukraine can actually supply gas, but also grain and cereal that the world is so much dependent on. I think we're in a very dangerous dynamic where energy is used as a weapon, and we did see Russia blackmailing clients in the European Union to pay them in rubles, then cutting off supply to Bulgaria, to Poland. So I think Putin clearly sees energy as the weapon, and this will lead to a major revolution in the European Union, exactly to decouple itself from Russian energy supply.
Yeah, the weaponization of energy, front and focus, front and center for us. And also you touched on commodities, of which, of course, Ukraine plays a major role. What has the ability been of the Ukrainians to continue to ship those commodities from ports like Odessa that have come under attack?
Well, you could call it's another front to ensure that Ukrainian soil is planted with those much needed corn, grains, wheat. And to be honest, it's a battle because there's a lot of risks. Ukrainian agricultural producers and, agricultural workers actually in some places have to wear bulletproof vests to save their lives as they are sowing Ukrainian soil. We have a major problem because of the Black Sea blockade of all the ports. There's a lot of floating mines, and even if the blockade is taking off, it will be very difficult and will take time to restore those routes. But we do know that Romania is trying to restore the old railway connection all the way to Ukraine, that then this Ukrainian grain can go through Romanian ports and further on. That is so much needed in sub-Saharan Africa, China, and other locations.
Indeed. Now, you've talked about the need ultimately for a decisive victory for Ukraine. What would that decisive victory look like, and why is that so central to the future of that country, but also Europe?
Look, Tom, we are having this instability in Europe that led to the major war since 2014 and really since 2008 when Russia invaded Georgia. And what I mean by decisive victory is that this doctrine of Putinism that is telling that Russia should gather its historical lands and restore its empire, call it Soviet Union or whatever, has to be doomed. And that means that Russians should not be allowed to consolidate any new territorial gains in Ukraine, that Russians, the ceasefire should include the precondition of Russian troops withdrawing all the way to the line of the 24th of February, that the West actually remains united in making sure that Russia also reforms internally, and sanctions are squeezing out Russian capacity to rearm and to threaten its neighbors. So there's a lot on the plate, but I think that decisive victory means also new Russia that will emerge on the kind of wreckage of that Putin's doctrine I was talking about.
I mean, given what we've heard from some US intelligence and military officials over the last few days about this being a war of attrition and potential escalation from the Russians, that arguably, some would say, seems like wishful thinking, the scenario you've mapped out. And also, of course, your response to the concerns that you could, if you followed that methodology or at least that outcome, lead to a tipping point where Vladimir Putin reaches in to the nuclear arsenal.
Actually, if you follow the recent intelligence report, they're actually telling the opposite, that the risk of Russia using tactical or strategic nuclear weapons is not as high. But I think what we have to also see that Russia is not gaining any tactical gains and strategically is also losing. Look at the international scene. Finland and Sweden actually is now trying to join NATO, whereas Putin was trying to stop NATO. Russia is not making substantial territorial gains in the Donbass. And United States has signed a major land-lease line for Ukraine on top of the 40 billion assistance. There is a capacity to push Russians out. Otherwise, there would not be all those efforts to allow Ukrainian armed forces to persevere and to defend Ukraine and, for that matter, Europe.
Okay, fascinating insights. Thank you for your time. Arisia Lutovic, head of the Ukraine Forum in the Russia and Eurasia program at Chatham House. Thank you for joining us this morning with your analysis. Coming up, Allianz sets aside an additional $2 billion to resolve lawsuits and probes tied to the collapse of its structured alpha hedge funds. More on that story next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back. Almost 2 hours into Wednesday's trading session, you're seeing more conviction in the risk-on move that we're seeing across European equities, gaining more than 1%, and certainly moves as well into debt, sovereign debt, particularly BTPs, and yields coming off there, building on the drop in yields that we saw yesterday. About a 14 basis point move yesterday in BTPs. Currently, in terms of the 2-year, you're seeing a move lower in yields by about 8 basis points, and with the 10-year currently at 2.93, a 6 basis point move lower for the Italian BTPs. Euro popping up 0.4%. Christine Lagarde of the ECB just clarifying the outlook in terms of those asset purchases and when rates may start to rise within weeks of that buying starting to end, is what Madame Lagarde said. Let's get to Allianz now, setting aside an additional $2 billion to resolve lawsuits and regulatory probes tied to the collapse of its Florida-based structured alpha hedge funds 2 years ago. That brings its total hit to nearly $6 billion. Joining me now is Bloomberg's finance reporter Tom Metcalf. Tom, so another big set aside in terms of $2 billion for Allianz. The shares are up today, though.
Yeah, it's a bit counterintuitive, but I think it's basically this idea that perhaps this is drawing a line under what's been a pretty horrible scandal for Allianz. So yes, $2 billion hit, but I think the shares are up by more than 2%, and it seems that investors are saying, hey, maybe we're near the end of this.
Just recap for us how we got to this point with Allianz.
Yeah, it's one of the more extraordinary trading moments in the COVID crisis. You know, Allianz, a big, kind of typically seen as quite conservative player, suddenly its hedge funds basically imploded. And what the lawsuits are saying is basically they started to lose money and then took bigger and bigger risks, tried to make that money back, and it all ended in tears. And since then, they've been being sued by, huge investors, massive US pension funds, saying, hey, you owe us billions of dollars.
Hence setting aside about $6 billion. What does it mean for the reputational risks then of this company, particularly when it comes to those clients in the US?
Yeah, I think that's where, you look at the numbers. Yes, they sort of close this off at $6 billion, but what does this mean for people thinking about investing in Allianz? And, these are very serious accusations. They basically said they sort of skewed the investment mandate. So all to be seen.
Tom Metcalf, thank you for breaking down that Allianz story for us, an update, of course, and how much they're setting aside. In terms of the markets, just recapping, gains of 1.2% here in Europe. You've got upside as well in the future stateside. S&P IMIs pointing to gains of more than 1%. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kelly Lyons in New York, and Anna Edwards here in London. Stay with us. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The cadence we're going now seems about right to me.
I think the Fed is trying to find an excuse to blink without blinking.
The Fed is very much setting the tone.
The market has finally gotten to the point where it's digested the level and the degree to which the Fed's going to be hawkish.
The markets don't care because they're just all focused on this one thing. The Fed is going to raise interest rates. Inflation is going to run away.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, May 11th. Our top stories today. Investors waiting on today's U.S. inflation report. CPI is expected to show that price growth has slowed to 8%. That's unlikely to be enough, though, to make the Fed change its plans. The struggling stablecoin Terra USD takes a dive. The token plunged from its intended one-to-one peg to the dollar to trade now at about 40 cents. And a different battle between Ukraine and Russia, this one about natural gas. The dispute is now disrupting Russian gas that flows through Ukraine to Europe. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, another day of buying stocks, and we're buying bonds as well, it seems, but crucially waiting for that inflation data.
Yep, all eyes will be on that print at 8:30 a.m. Eastern time, so about 3.5 hours to go, Anna. But as you say, it is a positive day for equities really across the world. That was true, too, in Asia, where stocks broadly were higher, a move led by China in particular. Now, on the one hand, you did have some bad news out of China overnight in that both consumer and factory inflation rose at a faster pace than expected, due in part to COVID-related lockdowns. But the actual good news that is boosting sentiment in Asia today is actually related to COVID. Cases on the decline in places like Shanghai, where we saw a 51% drop in cases on Tuesday from the day before. So that's helping lift risk sentiment. They have the CSI 300 up about 1.5% overnight as a result. One stock to point out in Asia, though, that was moving lower was a Japanese stock, Toyota. Of course, the world's biggest automaker gave a weaker than expected forecast, citing an unprecedented rise in costs related to things like logistics and raw materials. So that offsetting some of the benefit of a weaker Japanese yen. That stock ending the day lower by about 4.4%. On the subject of the Japanese yen, though, it is not, in fact, weaker against the dollar today. It's actually one of the outperformers in Asian FX, stronger by about 0.5%. We remain just under that 130 level, so the same range we've been in really for several weeks now. And finally, I would just note you are seeing that bid into the bond market globally. Yields moving lower again today. That was true, too, in Australia, where the 10-year yield came in about 6 basis points to right at 3.5%, Matt.
All right, very cool stuff. I am, of course, continually obsessed with the terror story, and we're going to get to that in just a moment. But right now, take a look at S&P futures gaining 1% and change. So there's a risk-on attitude here. On the other hand, you still see investors buying 10-year debt. You would think normally that they do that if they're hiding from something, but I guess it's an everything rally, a little bit of an everything rally today. 10-year yield down to 2.93%. Crude rallying as well, up 3.25% to 103.03. This is the NYMEX trade, and Bitcoin up just about 0.7%. Not much change from where we saw it here yesterday at 31,214. However, this is very interesting because you would expect the entire crypto world to be in shambles right now, considering what's happening with Terra. It continues to happen with the biggest algorithmic stable coin. I mean, $18.5 billion in Terra is supposed to stay exactly $18.5 billion. But of course, yesterday we saw it plunge to 60 cents. Today it came down to about 20 cents, currently trading at 46.80. The backer, Do Kwon, has said he's very close to finding a solution, but for something that's supposed to be at $1, this is a shocking failure, a total and complete collapse. And it's interesting to me, Anna, that it hasn't affected Tether. That still holds its peg, and other coins like Bitcoin and Ether are actually rising still today.
Yeah, absolutely. We'll look to see if there is read across into other crypto stories, of course. And Matt keeping an eye on that for us. In terms of the European story then, European equity markets, as Matt said, seeing a bit of that buying everything sentiment as we wait for the CPI data out of the United States later. So buying stocks, we're up by more than 1% on the CAC 40 and on the Xetra DAX. And we're seeing strength coming through a little bit from the earnings story, but has anything really changed to support this rally after we saw that heavy selling at the end of last week and at the start of this? In terms of the broader picture then for equity markets, we're also focused on what's going on with gas prices. So let me talk you through this. We actually saw a jump in European gas prices at the start of trade today, but we've actually come back from that. So we're now down by 1.4%. The reason that those gas prices jumped, because we are seeing disruption now, a stoppage in the supply from Russia to Ukraine through one particular pipeline. But when we saw flows diverted in some instances to another pipeline, that allowed the price to come back down from earlier spikes. So that's what we're seeing on the natural gas front. The euro in focus, up by 0.4%. We're watching Christine Lagarde. She's been making a speech earlier on today. She seems to be putting herself in Team July. Is she suggesting that we'll see an interest rate hike just weeks after the ending of the asset purchasing program at the ECB? That seems to be the thinking there. And buyer in focus as the Biden administration urges the Supreme Court to find against Bayer in its appeal on the Roundup weed killer trial. And Roche, also some bad news there, but this on a drug trial around a cancer drug, and that led investors, or analysts rather, to ask whether this had much of a long-term future or as much as had been assumed previously. On to some Russian assets, and the big story around Russian oil here is that Hungary continues to be on a different page from the rest of Europe when it comes to blocking Russian oil imports into the EU. And interestingly, on Russian debt, we're also watching a discussion at the Treasury. Janet Yellen saying that they are, Kaylee, discussing whether to continue to allow that exemption, which means that bondholders of Russian debt can continue to receive those payments in connection with those bonds. We'll watch that story.
Absolutely, and we'll be watching a lot of other stories in the day ahead, Anna. Of course, we'll get U.S. CPI data at 8:30 a.m. New York time, as we've been discussing. Plus, Atlanta Fed President Raphael Bostic will be speaking at 12 p.m. New York time. And finally, after the bell today, Disney will be reporting its earnings, Matt. All
right, we'll be paying close attention, obviously, to the House of Mouse. Right now, I want to get back, though, to what's going on with this supposed stablecoin, Terra, the algorithmic stablecoin, the biggest one. I think it's the 10th biggest trader by volume on coin market cap. Yesterday, we spoke with Avalabs President John Wu about the purpose of stablecoins.
Stablecoins serve a huge purpose in the crypto and the DeFi economy, and they're here to stay. And I think it'll also help out, all activity on various chains. So I hope the regulators recognize that as well.
John also pointed out the difference between an algorithmic stablecoin and an asset-backed stablecoin like Tether, which is holding its peg. But let's talk to Eddie Vanderveld about what's going on here. Shockingly, the founder, Do Kwon, he keeps tweeting, "Steady, lads, hang tight, stay strong, lunatics. I'm going to come up with a solution." But you want your dollar to be worth $1, don't you?
Right.
right? You want a stable coin to be stable. It's kind of in the name, right? But clearly, you know, when you trust the math and when you trust the correlations, which is what they've done here, sometimes those correlations change. We've seen this in wider markets, right? Correlations across asset prices, when on the way down particularly, they tend towards 1. So when you use a basket of assets to, you know, approximate what you think the dollar is going to do, and then you see the cryptocurrency space draw down, if you then use a lot of crypto, you know, you're gonna see those things tend towards 1. You're gonna see the space as a whole going down at the same time. We've seen this time and time again in cryptocurrencies, and that's why most of the big, you know, the Tethers, the USD coins, that's why they have most of their assets in highly liquid, outside of the cryptocurrency space assets. You know, that's why they're staying stable right now with assets of, you know, a total of, I think just for those two, $130 billion.
Well, and Eddie, of course, as you talk about a drawdown in cryptocurrencies, Coinbase, the crypto exchange, also out with earnings yesterday, warning of a drawdown in volume, saying it's going to be even worse in the current period than the last. And the CEO also talking about the black swan risk of a bankruptcy. What is your reaction to all of that?
You know, I think this is the crypto space growing up a little bit. You are seeing that as they have a wider investor base, as they are trading on public exchanges, they are finding that they have to update their investors, right? And I think that's what we're seeing here. They are being cautious. They are saying, listen, we're ahead, aware of the volatility that we're seeing across the space, and I actually think this is a good thing, just updating your investors. It's not like previous times in the crypto. Yes.
Eddie, the big problem here, I think, is if they do go bankrupt, they point out, if you're holding your crypto on their exchange, you could lose it all. And this is a massive problem for one of the central tenets of blockchain-based currencies. You should have ultimate ownership. But if you've let them stay on Coinbase, they could be wiped out.
Oh, absolutely, absolutely. It is a problem. But at least we're not in a situation where we were 2, 3, 4 years ago, where exchanges just went bust. There was zero warning. Now, are we going to see a bit of a run on those assets inside of Coinbase? I think time will tell. I mean, it is a big red flag for the people who've left their all of their crypto there. But I mean, you know, those in the crypto space who've been there long enough will tell you, look, all of your money that you want to keep in stable, you know, keep it in off-exchange wallets.
Eddie, thanks very much. Bloomberg's Eddie van der Veld with the latest there on crypto. Broader markets now. US inflation is in the spotlight today with April CPI growth set to slow. Bloomberg's Michael McKee spoke to Cleveland Fed President Loretta Mester exclusively.
It will take some time. I don't expect we're going to get inflation down to 2% this year or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. You know, I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy.
Let's get more from Bloomberg's Laura Wright on the inflation front. And Laura, we had Chinese inflation overnight. We now focus on US inflation.
The market on a knife edge awaiting US CPI data. I spoke with one strategist yesterday who told me, look, Laura, right now we're all armchair economists in this environment. The projection is for 8.1% the month of April, year over year. If that materializes, it would be a slight moderation from the previous month's reading of 8.5%. And that would be driven by declining goods prices, offsetting increased prices in services. Now, if we do see a strong beat on CPI, there will be pain for risks assets, likely an outsized reaction in nominal yields. But that said, traders appear to have priced in that we have seen peak inflation, and that is illustrated by 5-year break-evens, which have fallen below 3% yesterday for the first time since February the 23rd, with a 30 basis point downward move in the last 2 sessions alone. Now, for China, it was a beat on both CPI and PPI, with CPI landing just over 2%, PPI at 8%. For consumers, that was higher food costs, higher fuel costs. Producers, it's a story of supply chain congestion, elevated commodity prices, rolling lockdowns in China. But these upside beats beg the question, can policymakers in Beijing inject more stimulus? And that means, will Beijing, after all, be able to achieve its growth target of 5.5%?
Yeah, absolutely. And what kind of stimulus? What's going to look like? Laura, thanks very much. for that report on inflation, global inflation. Let's get to Ukraine. Russia has clashed with Ukraine over natural gas sent to pipelines that are intended to end up in Europe. It's a dispute that is disrupting supplies again, leaving Ukraine for the first time since the invasion in a pretty vulnerable position energy-wise. Ukraine says the Russian gas flowing from one of two key entry points will stop today. Anna Shuryevskaya, Bloomberg natural gas reporter, joins us now for more. So Anna, first of all, it's pretty amazing that the gas has continued to flow through despite the war over the last month and change. But now I guess that's over.
Well, it's not over completely. Gas is still flowing via the second of the two key entry points for Russian gas into Ukraine for transit into Europe. The flows halted at one of the stations because Ukrainian grid operators said that they cannot accept gas because the infrastructure is now controlled by the occupying forces, so they can no longer control operations themselves. Still, nonetheless, flows into the second station somewhat increased since yesterday. So overall, we are talking about an 18% decline in Russian gas flows via Ukraine to Europe today versus yesterday. So it's not complete halt yet, but nonetheless, risks remain because obviously the two countries may now engage into rhetorics and blame each other, and it's still a story that's developing.
All right, Bloomberg's Anna Shuryevskaya, thank you so much. Now let's head over to Washington, where the U.S. House has approved a $40 billion emergency spending aid bill for Ukraine. That measure pays for new weapons and provides economic and humanitarian assistance. Anne-Marie Horton, Bloomberg Washington correspondent, joins us now from D.C. Anne-Marie, should we expect this also to sail through the Senate?
Yeah, it is likely to sail through. I mean, the bipartisanship on this bill is huge. You had a 368 to 57 votes. You can see there on both sides of the aisle, there's a lot of support for sending more money and Ukrainian aid over. This also comes after Senate Republicans actually spent lunch sitting down with the Ukrainian ambassador to the United States, Oksana Markarova, and left that lunch saying they do feel like Ukraine was using these funds in the appropriate manner. But we should note, this is a huge package. The president asked for $33 billion. This is $7 billion more. A lot of that is going towards defense and humanitarian aid. $20 billion really for the defense part of that. And we should note that $9 billion that will be used in the Pentagon to restock the U.S.'s stocks because they sent so much over. You also have funds going to things like global food and humanitarian security, as well as money to repair the U.S. embassy in Ukraine. But Kayleigh, as you say, just right now it's in the House. Next week, likely it'll sail through the Senate.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horton in Washington with an update on aid from the U.S. to Ukraine. Coming up, we'll get back to the markets conversation. Ben Gutteridge, Director of Model Portfolio Services at Invesco EMEA, joins us. What is he expecting from the inflation picture out of the U.S.? How game-changing will this number be or otherwise? And the hardest hit U.S. town is having to put up with 10% inflation and $6 milk. Apparently that's a lot. Read more about it in today's Big Take story. Just type NI Big Take into your terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination
For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and on Bloomberg Television. I'm Matt Miller here in New York with Kaylee Lyons. Anna Edwards with us out of London. Now, we're focused pretty firmly on inflation today. We're going to get the CPI numbers out a little bit later. I have a chart here that shows U.S. break-evens, and 10-year and 5-year break-evens are both now below 3%. 2-year break-evens coming down under 4 right now at about 3.75. So inflation expectations are abating, and the question is, what does that mean for markets? Do we move on to growth fears rather than inflation fears? Let's bring in Ben Rahm to talk about this. He's a Bloomberg cross-asset strategist. He writes for the MLive blog. Ben, what do you think about today's print, and if we do see that inflation has peaked, what's that going to mean for markets going forward?
Morning, Matt. If we do see that inflation has peaked from today's print, what we will see is a continued rally in rates. Why do I say that? Because we were pricing in 200 basis points of steepening from the Fed in the next 5 meetings. Now we have come off those levels now. We are pricing in about 185 basis points. Now, if we get evidence further today that inflation is, as predicted, cooling, then that pricing will loosen some more. And therefore, I think that we have seen the peak on the front end yields, specifically the 2-year yield. And I think that we will move back to around 252 levels on the front end.
Okay, so 2.57 is where we trade. We'll remember that number as we go into the print then, Ben. Let me ask you about FX markets, because dollar strength had been such a theme in recent weeks, and that seems to have stalled just in the last couple of days with greater risk appetite. If we go into the second half of the year, though, worrying more about growth, where does that leave strong dollar and other FX?
I think that I just wrote yesterday on the terminal that we are approaching peak territory on dollar strength, and that was predicated on the steepening and only tightening factored in by the markets for the Fed. Now, if we are going to come off on that Fed pricing, I think that is going to remove that much of dollar support. And I therefore think that the dollar may weaken from these elevated, very elevated levels that we have seen of late. Specifically, that means that the dollar index will come off those 103, 104 handles back down to more moderate levels of 100 or so on the index.
Ben, thanks so much for your time. Ben Rahm of the Bloomberg Markets Live team, thank you for joining us. Remember, you can get some market analysis, the up-to-date take from the Markets Live team on their blog. MLIV Go is the function to use on the terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Researchers in Shanghai says China faces a tsunami of coronavirus infections if the government abandons its long-held COVID-0 policy. They warn that could lead to 1.6 million deaths. The study says that China's vaccination campaign would be insufficient to prevent an Omicron wave that would swamp hospitals. President Biden wants to do something about rising food prices. He's proposing measures to reduce costs for farmers, such as doubling investment in fertilizer production and extending government programs that use technology to reduce the use of fertilizer, and so-called double cropping insurance that gives farmers coverage if they plant more than one crop will be extended. Economist Lisa Cook will be the first black woman on the Federal Reserve Board of Governors. She won Senate confirmation by the narrowest possible margin. The 51-50 vote required a tie-breaking appearance by Vice President Kamala Harris. Republicans, of course, had questioned Cook's qualifications, Anna.
Coming up on the program, Ben Gutteridge, Director of Model Portfolio Services at Invesco EMEA. We will work our way up to that inflation print later on today. What's at stake for bond markets and then hence other assets? This is Bloomberg.
We know that it's highly transmissible. We
We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors waiting for today's U.S. inflation report. CPI is expected to show that price growth has slowed to 8%. That's unlikely to be enough of a fall to make the Fed change its plans. The struggling stablecoin Terra USD has taken a dive. The token plunged from its intended one-to-one peg to the dollar to trade at about 40 cents on the dollar. Crypto markets are waiting for a rescue by Terra USD's primary backer. And a different battle between Ukraine and Russia, this one about natural gas. The dispute is disrupting supplies of Russian gas that flow through Ukraine to Europe. Ukraine blames the disruption on Russian forces. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, we do see quite a lot of risk appetite then, European stocks moving higher, bonds being bought as well. But we're really waiting for the next take on U.S. inflation, I suppose, to work out where we go next.
True. I mean, CPI is where we're focused today. But it's interesting that we're seeing still so much risk on appetite here, even though we have the collapse of Terra and the warning from Coinbase, etc. So it doesn't look like there's a lot bleeding over from one portion of the crypto universe into the rest of the crypto universe, or indeed the rest of the markets. Plain vanilla S&P futures up more than 1% right now. U.S. 10-year yield coming down right now, 293, but that does mean investors are buying bonds, so maybe hedging their bets. Crude up 3% at 102.75. That's for Texas Intermediate. Then Bitcoin right now at 31,376. So it dipped below 30,000 a couple of days ago, instantly shot back up, and now we've been hovering at this level for about 24 hours. Check out Terra. You mentioned Do Kwon, the backer of these lunatics, as they're known, because Terra is connected to the cryptocurrency Luna, and they have both collapsed. Terra, of course, is supposed to stay at $1. It's a stable coin, or it was a stable coin, an algorithmic stable coin, different from an asset-backed stable coin. Right now, it's worth about half that, 49 cents, and we're waiting on some kind of solution. But as I've said, Kaylee, it's fascinating that this failure hasn't bled through. There hasn't been contagion in the rest of the market.
Yep, no contagion into those asset-backed stable coins like Tether, no contagion really into Bitcoin. It's interesting, though, to see how this may affect sentiment, especially on the part of the retail trader. And that's where I want to point out Coinbase, which, of course, reported earnings after the bell yesterday, missed on expectations in the first quarter. Plus, it said that volume in this current period in the second quarter is going to be even lower than the first quarter. So clearly, a not great signal about sentiment in the crypto markets at the moment. And then, of course, you had the CEO, Brian Armstrong, Armstrong out on Twitter yesterday talking about their updated disclosures about how they hold crypto assets at Coinbase, and in the risk of a black swan event like a bankruptcy, everybody who has all of their assets at Coinbase could be at risk of losing them. So that's something to consider. That stock is down about 20% at this point, but it's an even bigger decline in early hours for Unity Software. This is a gaming developer. It gave a disappointing revenue forecast. It's down nearly 28%, while Rocket, of course, the mortgage company, also disappointed. It's down about 9%. Finally, Anna, I just wanted to point out Twitter because we have had some news around Elon Musk in the last 24 hours. First, Bloomberg reporting overnight that Apollo wants to lead a $1 billion financing package for Musk's takeover. But then Elon Musk himself yesterday was talking about, A, how he might give President Donald Trump, the former president, access to Twitter, once again, reverse that ban, if he does indeed come to own the company. But he did say that's an if. It's not guaranteed yet. And clearly investors also still have some questions about whether or not he's actually going to succeed. Yes, Matt.
And the former president has said he's not coming back to Twitter anyway.
Right,
so.
because Truth Social is out there. So that's something to consider. Point of story, though, investors clearly still have doubts about that because Elon Musk said he'd pay $54.20. Right now, that stock trading at $47.58, Anna.
Yeah, so the gap between those, the execution risk then on that deal. Let's have a look at where the European markets are. Only a couple of sectors in negative territory, actually. So it's quite broad-based, this rally we're seeing in European stocks today after the losses that we saw at the end of last week and the beginning of this. Stocks Europe 600 up by 1.2%. We're selling out of healthcare, buying consumer products. The euro in focus up by 0.3%, 105 handle there. Christine Lagarde seems to be in Camp July, Team July, when it comes to putting a date on when we get that first hike from the ECB. She suggested there could just be weeks between the end of asset purchasing and the first rate hike. Bayer is in focus because the Biden administration is suggesting to the Supreme Court that they should find against Bayer in its appeal on that Roundup trial. And Roche moving lower this morning, down by 5.5%. This after the company revealed the results of one of their trials of a cancer drug that's got some analysts asking whether it really has such a future as had previously been anticipated. On to some Russian assets for you, and big questions still about the EU's intended embargo on Russian oil because Hungary is still on a different page on that front. We're also keeping an eye on the Russian bond markets because the Treasury says that Treasury in the US this is, Janet Yellen, saying that they are doing some analysis on whether to extend that exemption that bondholders have for receiving those payments from Russia. We'll keep an eye on that story then, Kaylee.
Absolutely, Anna. Of course, we're also monitoring the Fed speak we have continued to get throughout this week, including from Cleveland Fed President Loretta Mester, who yesterday said she's backing up half-point rate hikes, but she would support bigger increments later if inflation does not ease. She spoke exclusively with Bloomberg's Michael McKee. Take a listen.
We don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. In the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, we might be predicting, then we can adjust at that point.
Ben Guttridge, Director of Model Portfolio Services at Invesco EMEA, is joining us now. Ben, even if we see the peak of inflation today, or it proved out that we've already seen the peak of inflation, does that mean we've seen peak pain in the equity markets?
Well, I mean, it will of course depend on the path for inflation and how policy evolves thereafter. I think, if inflation today does mark the start of a trend reversing inflation and it moving lower, then of course that will bring much relief to consumers and of course allow policymakers to tighten at a more cautious pace. So on that basis, yes, I think that would mark the end of the acute pain that we've seen in equity markets. But it could be a volatile period in the short term, of course, because there are still many growth challenges ahead.
Okay, Ben, good morning. What do we make of the fact we've seen break-evens dropping back in the US? So if you look out 5 years, 10 years, you get a sense that inflation expectations are coming down from these previously really elevated levels. That tells us maybe that the market's coming round to the Fed can do something about this. Does that mean stocks is that a situation that allows stocks to rally?
Yes, I think so. I mean, you're right. I would take it that the market has seen the intent in the Federal Reserve's eyes, if you like, that they really mean business on tackling inflation, and therefore longer-term inflation expectations have moved lower, and that can be supportive for equity markets. But we are seeing a lot of attention on sort of short-term data, and of course I think there would need some sort of corroboration, if you like, from CPI and CPI trends really to get sentiment moving in a more positive direction. But the platform is there from falling inflation expectations.
Okay, so for falling inflation expectations, stocks can rally, but which stocks then, Ben? Are you still looking for inflation fighters? Because even if you come down from 8.4% to 8% or so on inflation, that's still really high and still a long way to go. The path down to 3% still will take some time to navigate, I assume.
Yes, sure. And I don't know if I've been ushered into this sort of angle of stock conversation, but it's not necessarily my view that inflation is going to fall, dramatically,
right.
And that therefore the consumer is still going to be under pressure. We don't think a recession is the likely outcome, but we think equities can perform. But in an environment where you've got slowing growth, inflation a bit sticky but falling, you want to have more defensive sort of sectors in there. And that could be healthcare or consumer staples.
Even in Europe, Ben, you don't see a recession on the continent either?
Well picked up. Good point. No, I think in the US, it's less likely that we see a recession. In Europe, we're really flirting with it, aren't we? I mean, the data the soft data and the hard data has a real sort of recessionary flavour to it, and so we could well be on the cusp or in the midst of a recession in Europe. But of course, Europe has moved much more quickly to price in those negative growth expectations.
Ben, what is Model Portfolio Services? You're the director of Model Portfolio Services at Invesco. So what is that?
It's a place to hide. It's a place to be a coward. No, we need to build diversified portfolios and really not swing for it. But that doesn't mean we don't impart our views onto portfolios. We're just trying to build portfolios that are balanced. But as I said, our views we still have the room to impress our views, which would be a preference for equities, but probably more defensive type equities, US markets, and those more defensive sectors, given we're in the midst of a growth slowdown. But we still recognise the appeal of value assets and more inflation fighters that Anna was referring to.
Does it make sense to you then? I mean, the last couple of days we've seen, and I know you have certainly much longer term time horizons, but we've seen rallies in equities, recovery in equities, and investors buying bonds at the same time. Does that make sense to you right now?
Well, the short-term gyrations of investors can often be confusing, but the way we see investor behaviour at the moment is that there is a tremendous amount of nervousness, as revealed by sort of surveys, but it hasn't revealed itself in mass selling. I think there is still this sort of TINA element. There's very little alternative to equities out there, and so whilst they're nervous about holding equities, they haven't felt compelled to sell them. And of course, that makes us a little bit nervous in the short term. Is that if we do get sort of disappointments on data, that there could still be yet more selling to come. But bond markets are starting to look more interesting as a diversifier because those yields have picked up. So short-term activity is hard to call, but there is certainly some nervousness that equities could be under more selling pressure and that bonds could be bought from here.
Ben, thanks very much. Ben Guthridge, Director of Model Portfolio Services at Invesco EMEA. Thank you very much for your time. Coming up on the programme, the US inflation report is due out in just a few hours. We've been talking a bit about it already. We'll get some further analysis and discuss what to expect. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Our economy has gone from being on the mend to on the move. But for every worker I met who's gained a little bit of breathing room to seek out a better paying job, for every entrepreneur who's gained the confidence to pursue their small business dreams, I know that families all across America are hurting because of inflation.
President Biden there speaking about inflation at the White House yesterday. Investors will get fresh U.S. CPI data at 8:30 a.m. Wall Street time. For more on the global inflation story, we're joined now by Simon Kennedy, Bloomberg Executive Editor for Economics. And Simon, this is clearly a global problem. Every politician talking about it, trying to think of ways to address it, it seems. But it is a global phenomenon. In the U.S., we are perhaps coming to a point where we've reached peak inflation then. That seems to be what economists are expecting to see today.
Yeah, so we saw in March it was 8.5%. In April, they're looking at 8.1%. You know, an insane level if you'd thought about it 2 years ago, but at least it's so some signs of a peak there, although the concern actually is that we're going to plateau at above 8%. The core rate may pick up as well, which will throw into question that peak debate. And so it's definitely a tricky moment for the Fed, tricky moment for the Biden administration, just where prices will go. In theory, the leveling off of energy should have cooled somewhat.
Hang on, Simon. So Anna said, globally, leaders are all trying to think of ways to address the inflation problem. Is that true? I thought the idea was that in the UK, Boris Johnson
talking about it anyway.
Johnson doesn't have any ideas or any ways to address inflation for the people of the UK, right?
They're certainly talking about it, and there's various initiatives that they could produce, but certainly, yes, in the Queen's speech yesterday, light on details about that cost of living crisis. The onus still on the central banks to be the ones to lead this charge against the price pressures. But there are signs elsewhere of governments taking steps and trying to do what they can. But as has long been said, inflation is a monetary phenomenon, and that leaves it in the hands of the central banks, who are perhaps a bit too late to the party when it comes to a tightening monetary policy.
That's interesting, because I'm interested in your take on what the market is now assuming will happen to inflation. If we look at break-evens, we've mentioned this a few times on the program, break-evens, those inflation expectations in the market have been coming down, as if investors have concluded, oh, look, the Fed's actually going to be doing something serious about this and having some success. I mean, if you're looking for inflation to moderate, that's a really crucial data point to take on board.
Unless they're betting that the Fed will fail and that it'll be driving the economy into recession to beat the inflation, in which case you bring the inflation expectations down. For the moment, and there obviously has been a debate in academic circles and among economists about whether the Fed has got it right or wrong. The signs are that still credibility is with there's trust in the central banks to get it right. It'll just probably have to move. The Fed, for example, is going to move much faster than it was thinking it would have to earlier in the year, and Jerome Powell last week, talking over the heads of reporters and economists on Wall Street to the American people to try to explain that it's going to be cracking down on inflation.
Yeah, well, Simon, when Jerome Powell spoke last week, he also spoke of the risks stemming not just from the war in Ukraine, but also China and COVID-related lockdowns there. What signals should we take from the data out of China overnight that saw both consumer and factory prices up more than expected in April?
So certainly the prices are going up in China. There is some argument made today by Bloomberg Economics on the terminal that actually those COVID lockdowns will eventually add a disinflationary force to the world economy. One of the things that Jerome Powell and others, including Neil Kashkari, have pointed out is there's a lot affecting US inflation at the moment that is beyond their control. They can't drill for oil. They can't clear up COVID in China. They can't deliver better supply chains. So those supply issues, as long as those remain, those global factors, supply challenges, as long as those remain out there, as long as those continue to drive up inflation, the question for the Fed is, does it want to, how much does it need to crush the demand side of the economy to bring supply and demand back into balance? If it wants to do that or needs to do that, it's going to have to push interest rates up, perhaps much higher than what markets are thinking. Again, back to the data this morning from China, some signs of easing, but ultimately, again, topping forecasts there.
Simon, what more can the Biden administration do, let alone just the Fed?
So the Biden administration is looking at a whole series of ideas. One that's proved popular in recent weeks and hasn't been ruled out completely is the idea that you knock some of the tariffs that are on China that were imposed during the trade war. Obviously, that's a geopolitical, strategic question as much as a economic question. There does seem to be some divide within the administration over whether that's the right approach. But people such as Larry Summers, the Peterson Institute, have all proposed that dealing with the tariffs, taking some of those tariffs off, would provide some easing for the economy's inflation problems.
Okay, Simon, thanks very much. Bloomberg, Simon Kennedy with the latest on the U.S. inflation story. Of course, we heard from Laura about the Chinese story earlier on in the program. Inflation in food prices clearly matters a great deal in lots of parts of the world, certainly in many parts of the emerging markets. And Sri Lanka has been seeing some violence due to that and other factors. We're hearing from the central bank chief in Sri Lanka saying that he will quit if there is no stability in Sri Lanka. These comments coming through from the central bank chief. Earlier, we heard from the central bank that it was setting a daily trading ban for its currency against the US dollar, trying to stem the volatility there. And for more on the inflation story, check out today's big take story about the Texas town that is having to put up with 10% inflation and $6 milk. Just type NI Big Take into your terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. We are joined now as well by Tom Keene, co-anchor and creator of Bloomberg Surveillance. And you've got a single... By the way, have you made an NFT of your bow tie yet?
No, it's under discussion. The entourage is looking at it. We're really worried about it. When you look at, you know, if I'm going to do it, it's going to be called stable bow tie is where we're heading.
What's your single best chart today, Tom?
My single best chart is not on a train wreck in BitDog and the rest of them. We'll go cover that. Look for that on radio this morning, 10 a.m., 60 minutes straight of Matt Miller on BitDog. That'll be painful. Also painful is the inflation we're all living right now. This is a really, really, really important chart because worldwide you're living it. The little blue line is the guesstimate today, 8.1%. And what's important is the bottom line is the spectacular surge in goods inflation, think 11%. In service sectors even elevated a little bit as well from 3-ish out to 4-ish. The dispersion is tangible. Goods inflation is the bet. It's got to come in. We'll see.
Okay, I wonder what Bill Dudley, former New York Fed president, thinks we're going to see on the inflation story. I also wonder what he thinks about stablecoin, but mostly inflation.
Well, it's on inflation, Anna, and he just published. We'll have Mr. Dudley with us this morning. Dr. Dudley doesn't mince any words. He says this is a Fed that is way too coy. They've got to identify their plan forward, and what's critical is Dr. Dudley makes clear the goal of getting back to 4% is not acceptable. That's going to be the debate for later this summer.
Yep, what kind of inflation is the Fed going to be comfortable seeing at the end of this year? Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much for joining us. And like Tom, of course, I am going to be watching the CPI data today. We're just over 2.5 hours from getting that print. But what I'm really interested in is the market reaction to it, given we are seeing a continued rebound in equities today, and we have seen a dramatic pullback in inflation expectations as measured by break-even rates. The 5-year break-even coming in 31 basis points in the last 3 days. So if we do see an 8.1% handle number on inflation, does the market just say that reinforces our thinking that the peak is past us, everything's okay, continue on? Or would a hotter than expected print throw everything we've seen in the last couple days into chaos, Matt? It'll be really interesting to see.
Yeah, I cannot wait to see that CPI print. It's 8:30, right? So just about 2.5 hours from now, 1:30 UK time. I'm watching Terra USD, though, the stable coin, formerly stable coin, algorithmic-based, not asset-based, so it's different than Tether, for example, which has held its dollar peg. You can see here Terra trading at 48 cents, so less than half of where it should be right now. The backer Do Kwon, or as he's known on Twitter, Stable Kwon, has announced that he's close to announcing a recovery plan for UST. He says hang tight. He refers to his supporters as lads. He says getting close. He says stay strong, lunatics. I guess Diamond Hands isn't far off from what his next tweet could be, but it'll be interesting to watch what kind of solution he comes up with, because as Tom points out, you know, there's been a collapse in the price of BitDog from $69,000 just 6 months ago to under 30 a couple days ago.
I'm sure lunatics is a compliment, although it might not always seem as such. I'll be watching the House of Mouse, as you referred to it earlier, Matt. Disney earnings out later, the secret weapon perhaps as the real world fights back against the stay-at-home economy. They're parked, but we'll, of course, crucially be watching subscriber numbers. Inflation is up shortly. Surveillance is next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Setting the tone.
The Fed itself is trying to do something that they've never done before.
We are in a new regime in which inflation is likely to stabilize at high levels.
We have to get past not only the tightening of central banks, but then the impact on growth the other side.
The economy can continue to do really quite well, I think, even as interest rates rise.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is CPI Wednesday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up by 1 full percentage point. TK, the big one, at 8:30 Eastern Time.
Big one at 8:30. We're going to get physical on it. The last time we were at this inflation level, John, Olivia Newton-John had let's get physical, and we're going to find out if we're actually going to get physical and lower inflation. What's the bet, John? Do you think we can lower inflation?
If only you could see Bramo's face right now, TK.
I know.
She is disturbed and will be for the next couple of hours. TK, what are we hoping for? We're hoping to see a year-over-year peak in inflation. Hopefully that's behind us. What's Wall Street looking for? They're looking for the month-on-month number, core, hopefully coming in. That's not the expectation today, though.
You absolutely nail it, John, in that we are down to the micro rollover of inflation, not looking year-over-year, looking month-over-month. Great set of guests this morning to this must-watch, must-listen for Global Wall Street, culminated, John, by William Dudley later in the show.
Bill Dudley coming up, Lisa. His view, how high do rates need to go at the Federal Reserve? Probably a lot higher than you think.
If that's the view, and it still is the view for so many, then how do we explain the rally that we're seeing right now in treasuries? How do we explain the rally that we're seeing in equities? And there are a number of different expectations of perhaps inflation's not going to come in as hot. And I don't know if I buy that, John. I don't know that this is any sort of statement rather than a pause ahead of what could be a monumental CPI print.
But do you get the feeling, though, that the market is shifting attention away from inflation towards growth at the back end of this year? Morgan Stanley and Mike Wilson out overnight, basically saying we're expecting decelerating earnings growth, a lower multiple, elevated volatility. We continue to believe the U.S. market is not priced for the slowdown in growth.
And that, I think, is beginning to be priced, but you're not seeing it fully priced in by any means. Mike Wilson would agree, but you're also not seeing it fully priced into the credit sphere, because even though spreads have widened, they haven't widened that much. How much are we moving to that kind of narrative, and how much does that change if we do see inflation pick up further than people expected?
Great lineup for you this morning on Bloomberg Surveillance. Good morning to you. Let's whip through the price action. Equities are elevated, up by more than 1% on the S&P 500, on the NASDAQ up by 1 0.3, bouncing back potentially for a second session. This gets my interest, and I know it gets Lisa's too. Yields lower for a third straight session, down 5 basis points to 293.63. Lisa, 320 the high of the week. Ever since we hit that level, we have backed away, and backed away.
Which raises a question. Have we seen the peak in yields, or is this a breather? Is this people trying to take off some short positions ahead of what could be a CPI print that could potentially be weaker than expected or softer than expected, which could lead to a rally? We get that CPI print at 8:30 a.m. The expectation is for it to cool slightly from 8.5% down to 8.1%. I'm actually less interested in the headline number. I want to see the underlying components, and I want to see its effect on wages. Real wages have actually declined to some of the lowest levels in decades. If you take a look at the weekly average hourly earnings, I want to understand how this relationship works going forward in terms of how much momentum there is for the consumer. At 1 p.m., talking about that 10-year yield and how it's been declining in terms of just this sort of retracement of the highs that we've seen recently. At 1 p.m., we'll test that. The U.S. Treasury is selling $36 billion of 10-year notes. I know that Tom is watching that as he sings, "Let's get physical." Where did that come from, Tom? Honestly.
That's when we last had inflation this tall.
There were other songs too.
And let's just say, Lisa, his research is different to us.
Evidently, that's the case.
Special thing.
It is
Guys,
special.
I lived it. You should have seen my hair then. Continue.
Oh, well, I'm sure we're going to live it again, too, this morning. After market, we do get earnings from Disney, Rivian, and Beyond Meat. I'm curious to see not just Disney, but Automotive, Rivian Automotive, Motive, and Beyond Meat. They are among the meme stocks that did absolutely amazingly during the pandemic. Now down 78% for Rivian. We saw the concern about Ford selling shares at a discount. Beyond Meat down more than 50%. Disney, more of a question mark with streaming, but John, those meme stocks had absolutely had a massive retracement. Roblox, for example. All of our kids were on that now. It was crushed yesterday.
Lisa, thank you. Looking forward to your coverage on that through the day here on Bloomberg TV and on Bloomberg Radio. Look out for that. TK, I know you're focused on this. The difference between what Wall Street will trade on today and what Main Street feels. A big, big difference sometimes. And when we start talking about core, who at their dinner table is talking about core inflation?
Talking about core inflation.
Nobody
and
talks
I'm
about
going to go
core
Kudlow on you.
inflation.
Larry Kudlow was big on this decades and decades ago, John, and Mr. Kudlow is absolutely correct. It's a nominal statistic. The PhDs can go to Cleveland, Trim Dallas, and all the rest of it. Bill Dudley, let's look at it right now, John. I think it's so important to get through this before we get to our good guest this morning. Dudley focuses in, John, what you talked about yesterday, which is what do you do when you get back to 4% inflation? Even 4% could easily be an underestimate. The Fed is still providing stimulus for the securities, John, you talk about every day, which will take 3 to 4 years to wind down. This coyness is a mistake. It reinforces the jarring disconnect between Fed officials' commitment to curb inflation, to explain what that commitment will entail.
The former New York Fed president asking how high will Fed rates need to go, quote, probably a lot higher than you think. And TK, that's the issue at play here today. Some people will think that peak year-over-year inflation, all of that establishes a trend, the beginning of something, the start of a journey, the first line in a book, take your pick. For others, Tom, maybe we stay here. We plateau at a higher level, 3-4% to your point further down the road. I think Citi's on that page, Tom. TK, I think that's what Citi's looking for, which is ultimately why they see a more aggressive Fed in our future than others do.
John, flat out, 3% inflation is an academic discussion. Think Adam Posen, Olivier Blanchard, Stiglitz as well. We hope to see him in Davos. But, John, 4% inflation, nobody in the game thinks that's acceptable.
Joining us now is Steve Sosnick, the chief strategist at Interactive Brokers. Steve, let's start here. How important is this number to you at 8:30 Eastern Time? And for you personally, what are you looking for?
I'm not going to do... Good morning, John. I'm not going to deviate too much from the economists' estimates. I'm not an economist, so I'm not going to play one on TV this morning. But I do think that it's right to think that we are seeing a peak in inflation. But remember that inflation is the rise in prices, so it doesn't mean we're seeing peak prices, even if we see inflation abate. And I think that gets a little lost sometimes. Is we focus on the headline number, but don't necessarily realize that it's a rate of change, not actually the price level.
Steve, what's your expectation for how the market is positioned in terms of where the parameters of risk are? How much is this really setting up for either a pop rally or, frankly, a sell-off on a number that even comes in line?
You know, Lisa, it's very interesting because we've seen our customers being net buyers of their favorite stocks throughout this whole thing. So I do think there's a certain amount of good news baked into the cake right now. But you know, the question then becomes how much is a disappointment at this stage? Because if we're already expecting 8, you know, if it comes in at 8.2, is that enough to get people really crazy? Either way, we've got a big number. So I think the market is more trying to find a level, but I do see that it feels ripe among a lot of traders that if this number is a decent one, they're going to try to pump it right after the number comes out. Yesterday, we had a false breakout on the open. Today, if you get a good economic number with this kind of start that we're having, you could really get some enthusiasm from people who are eager to pounce.
Everyone's expecting volatility, Steve, and we have seen the expectations rise, at least according to VIX and the MOVE Index of the Bank of America Merrill Lynch vintage. How much is it really underestimating the volatility versus an accurate representation, considering the fact that it's well below recent highs?
Well, there's different ways to break it out. You know, I have to think in terms of, you know, historical volatility, implied volatility, realized volatility. That's always been that's how a volatility trader makes his money is between the three. VIX, remember, it's a fluky calculation. You know, it's a 30-day look ahead. So if you think about it this way, if you use the rule of 16, which is basically take these volatility numbers, divide them by 16, and that's what the market's expecting on a daily basis, well, that's about a 2% number. A 32 VIX is roughly a 2% number. Well, we've been moving 2% every day. So if you want to think of VIX as being a fear gauge, well, it's not displaying peak fear. If you want to think of VIX as a volatility measure, which, by the way, is what it is, it's actually in the right general place. We're that volatile right now. Going forward, VIX has got a bit of backwardation. The outer month VIX is a little lower, but then when you think about it, it's hard to sustain this kind of movement on a long-term basis. So we're not seeing full panic, as I would call it. This is what it is.
Steve, got to leave it there. Wonderful to catch up. Big day ahead of us. Steve Sosnick there of Interactive Brokers. A Bloomberg subscriber just wrote in, rather worryingly, I was indeed discussing headline and core CPI at the dinner table last night with my wife and children. I think that probably says more about Bloomberg users than it does about the rest of the country, but point taken. I think for a lot of people today, Tom, at the kitchen table, they won't be discussing where core CPI printed today and what Wall Street traded on off the back of that. It will be about where gas prices are right now, approaching 450, going through that level. TK, that's the fear that a lot of people in this country and beyond around the world have at the moment.
And Kriti Gupta's done great research on this, John. This substitution from meat to chicken is not funny. And this is not, you know, Abramowitz going into the, you know, fancy grocery store and going, oh my God, skinless breasts, look at that. And the answer is people are really struggling and they're making a substitution to cheap cuts of chicken to get away from what they're seeing at the meat counter. That's the basic story.
John, I love how Tom projects his expensive forays to the grocery store and to Prada.
And I also enjoyed the director taking your shot up and putting the Bramo cam on live, reacting to TK as he makes that comment.
I just, you know, honestly, I'm not the one that you're going to pinpoint, but it's true. And honestly, and we didn't even mention this. I didn't put it in the brief, but the president's going to be talking about that. He's going to be in Illinois talking about, you know, the cost of food and the cost of the Putin price hike.
That's what they're calling it.
Yeah, exactly.
I've seen the press release.
They're trying to label it that way. It's not sticking, is it?
1:15 Eastern Time. The president delivering remarks on Putin's price hike and his administration's actions to support farmers and food processors, lower their costs and lower prices
He's on at 1 p.m.
for families.
Today?
1:15.
Volume 2,
I did not know that. He was on
1:15
yesterday.
p.m.
I know.
We go again.
That's why I went with the auction.
We go again. Futures up 0.9% on the S&P. The Nasdaq up by 1.1. Do you promise to do this the whole morning?
Well, really? I'm trying to give you the inflation of Volcker, the inflation of another time.
Wonderful. You're taking us back, Tom. You're taking us back. No one wants to go back there. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Kritika Gupta. Investors are waiting on today's U.S. inflation report. The CPI is expected to show that price growth has slowed to 8.1%. That is unlikely to be enough to keep the Fed from raising interest rates a half percentage point the next two meetings. The CPI comes out at 8:30 a.m. New York time. And the U.S. House has approved a $40 billion emergency spending aid bill for Ukraine. The measure pays for new weapons and provides economic and humanitarian assistance. And it's significantly larger than the $33 billion President Biden asked for. The bill now heads to the Senate, where approval is likely next week. Economist Lisa Cook will be the first black woman on the Federal Reserve Board of Governors. She won the Senate confirmation by the narrowest possible margin. The 51-50 vote required a tie-breaking appearance by Vice President Kamala Harris. Republicans question Cook's qualifications. Researchers in Shanghai say China faces a tsunami of coronavirus infections if the government abandons its long-held COVID-0 policy. They warn that could lead to 1.6 million deaths. The study says that China's vaccination campaign would be insufficient to prevent an Omicron wave that would swamp hospitals. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
The first rate hike, informed by the ECB forward guidance on the interest rates, will take place sometime after the end of net asset purchases. I have been very clear that this could also include a period of only a few weeks.
Christine Lagarde, the ECB president there, looking forward to June 9th, the next ECB
Looking forward to that.
meeting. We are, she's not, I imagine. Tom Keene, Lisa Bramett and Jonathan Ferro. Futures positive about 1% on the S&P, on the Nasdaq 100 up by 1.13. Yields are lower again for a third straight session, down 5 basis points on a 10-year, 293.82. We had a little look at 320 earlier in the week. HSBC publishing literally seconds ago. Steve Major and the team making a move on their bond yield forecast. They raised them. Here's the quote. We adjust our yield forecast to reflect the floor established under yields by hawkish central banks. 10-year yields for N22 raised 50 basis points to 250, Tom. They raised their bond yield forecast to 1% from 30 basis points for the end of 2022. Just out from HSBC and the team moments ago, Tom.
And that's really important, John, because it shows the difference here, transatlantic, and the challenge that Lagarde has. That German 1% statistic really gets me because, John, I believe on a 10-year German, we're there right now, 0.98%.
For many people, I'm not suggesting that everyone is thinking this right now, but Lisa, for some people at least, they'll be looking at where yields printed earlier this week, the move we've had since, and the fact that a long-time bond bull like HSBC has come out and pushed their forecasts up, and wondering whether we're close to that kind of point where the pieces start to come together and people come on programs like this and saying, maybe 320 was it.
Honestly, yes. I think that the fact that a major bond bull is capitulating in essence and basically saying we are not going to get back to the lows of 1%, which is some of the ideas that were floating around as recently as 6 months ago, is telling. It shows that people are expecting inflation to be longer and to really have a more prolonged feel on this economy, including at Hoisington, another massive bond bull, also raising some concerns about that longer-term inflation outlook.
I'll repeat something I've said a few times this week already. Every time we try and establish any kind of narrative around the bond market, Tom, you just get punched in the face by it seconds later. So I think we've got to stay really, really open-minded about the two-way risk in this market.
We will report to you what the experts say, folks. That's what surveillance does, but we don't have a narrative here on what yields are going to do. She watches the narrative in Washington. Anne-Marie Horton joins us now, Bloomberg Washington correspondent. Anne-Marie, you are too young to remember Olivia Newton-John, Let's Get Physical. The president does, and he remembers the politics of the time and place, which is this repeat show on inflation we're going to see. What is Ron Klain doing? What is the White House doing to have the president come out, may I editorialize clumsy, 2 days in a row on inflation?
Well, the president said at the very top of his speech yesterday, and I was in the room there, and he said, I'm going to give a speech on inflation. It likely won't be my last one, and it certainly won't, because he's going to talk about it yet again today when he's in Illinois talking to farmers. What his chief of staff, Ron Klain, and the strategy, and you can see in the tone and the shift when the president is talking about price hikes, it's no longer about his policies that he thinks could help, even if it's not in the short term, longer term, to reduce the inflationary impacts on American families. But now they're taking aim at the Republican Party. And the president said yesterday, I'm going to show you two paths. And one is my plan, and the other is the, quote, ultra MAGA, and taking aim at some of these plans. Some Republicans, not all, in Congress say that the U.S. should be going towards and for economic policy.
Let's assume there's no plan that's executed because of an election year. What is the distinctive feature of the Biden plan?
Well, it's the entire Build Back Better policies that they're just changing in terms of a PR that are no longer about build back better, but are now about lowering the costs for the future. But the president did hint and open the door to something that could have potentially a little bit more of an immediate impact on inflation if you talk to economists. And this really wasn't news. I mean, the press ran it as it was big news, but Secretary Yellen has said this before, and she said it most recently in an interview with Bloomberg a month ago. And this was, of course, if you were going to remove the tariffs on China. The Peterson Institute says that will bring down inflation about 1.4%. So there are some more immediate effects the administration can do, and they're discussing them, but they haven't quite pulled the trigger.
Meanwhile, Anne-Marie, we're looking at ESG getting a lot of blowback in the face of high gas prices from the likes of Mike Pence, talking about wanting to rein in ESG, environmental, social, and governance types of activities because of a lack of investment in fossil fuels. How much is this a talking point that's gaining steam on the right?
Well, I think this has been a talking point on the right for months. This was, coming out of the pandemic. They even talked about the fact, or even during the pandemic, remember, it was the Republicans who wanted to fill up the SPR at very cheap prices to make sure that they were keeping a very robust American fossil fuel industry. So this has been an issue for the right, and it continues to be. I asked the president yesterday why he's not telling consumers maybe to not go to the gas pump and take public transportation. He is someone who is very much so a train guy, and he said that his plan, although it is long-term plan, is this move away from fossil fuels and a greener and electrification of this grid. But that is not going to solve the inflationary pressures of another record day today of higher gasoline prices, and it's not going to solve their problems before November.
So we all know that this Putin price hike talk is just basically garbage for a lot of people. AMH, let's go there. We know that. But I do think the Republicans got to rise to the occasion here. The Democrats and the White House are trying to basically take the words of one Senator, Rick Scott, and basically say that's what that whole party stands for. When is Republican leadership going to come forward and try and get hold of that narrative themselves?
So two things. First, it's a great question because we have seen the likes of Senator Mitch McConnell really distance himself from that economic plan from Senator Rick Scott, and you've seen the Democrats just really take hold of that and paint that as this is the Republican Party now, and the ultra MAGA have absolute control of the Republican Party. So that's a fight, Jonathan, that's been going on, since the former President Trump left the White House of this Republican Party, and we're seeing it play every day in primaries across the country. On the Putin price hike, though, I will say for a lot of people, they do think it is just a PR stunt, but it is fair to say that taking out Russia, a massive producer of fossil fuels, of commodities, of wheat, is making the inflationary impacts we had before this war much harder.
Yeah.
Because right now, especially in the oil, gasoline market, it's a refinery capacity issue. It's not the top price oil issue. And when you take out Russia, that's almost 2 million barrels of refined products you just stripped away from the market immediately.
MH, you're right. It's great to catch up. Down in D.C., Anne-Marie Hordern. Putin exacerbating the existing trend, not establishing it. Tom, but obviously politics doesn't do nuance very well.
Let's look at some of the emotion here, John. Wheat, as the president visits the Midwest, wheat up 35% annualized, an explosive move. John, a loaf of bread in Britain up 9% from the beginning of the pandemic.
Futures up 1% this morning. Good morning to you all. On CPI Wednesday, the inflation data 2 hours away.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City, just a couple of hours away from an important inflation print. Going into that, equity futures elevated again, up 1% on the S&P, and the Nasdaq 100 advancing 1.25%. Everything could change in about 2 hours' time. So that's the price action for now. Take a look at the bond market. For a third straight session, yields lower on a 10-year to 293.82. Earlier in the week, we looked at 320. We've backed away ever since. We're down another 5 basis points on a session. Steve Major, HSBC, out a little bit earlier this morning, about 20 minutes ago, revising their forecast higher to 250. That's up 50 basis points. JP Morgan, Jay Barry, going out to 320 from 285. So the South side starting to boost their outlook for yields. At those two banks anyway, just as yields are starting to move the other way. Just a little bit for now. I think we're trying to will into existence the idea we've seen a top on a 10-year yield. And TK, as you and I have already said this morning, stay very, very open-minded. A lot of two-way risk still in this market.
It's a stretch. And as we talked to Liz Ann Saunders yesterday, she's out on Twitter with her world-class charts this morning, John. Really how silly this looking for a little rollover, used cars and all that.
Yeah.
And then it comes right over to the yield market, which is sort of calculus, hope, and prayer is how I'd put it.
Not trying to make judgments about a future, avoiding that, Tom.
Yeah.
I'm just trying to make observations about what I think is notable right now. And this is something really notable. Inflation expectations. Let's talk about this. We talked about it yesterday, so-called break-evens. You take the real yield from the inflation-linked curve, you subtract that from the closest nominal maturity. What you get there is the implied rate of inflation on that maturity. So let's take the 10-year. 10-year break-evens are coming in again, Bramo, to 264.91. Just that chart on the far right, just rolling over. I think this is interesting. I'm not saying it continues, but it's notable given the price action we've seen recently.
It confirms the fear of a growth slowdown more than the fear of runaway inflation in the face of stronger momentum in the economy for a longer period of time. That is what this says. We will find out which is the more predominant pressure, and could we get both, which is the worst case scenario.
That's exactly the point. This is something that Michael Harnett at Bank of America was talking about at the start of the year, something Mike Wilson at Morgan Stanley was talking about too, is that inflation fears translate into rate fears translate into growth fears. And Tom, are we very much firmly in step 3 now as we work our way through the year?
We work our way through the year with all of these dynamics moving. Someone expert at the dynamics of the financial system, the economic system, is Elsa Lingo. She's global head of FX strategy at RBC, but with a terrific CV of work for the European institutions. Elsa, when you look at Tom Porcelli's work at RBC on American inflation, how does that fold over into dollar dynamics and the foreign exchange market in general?
It's a really interesting question, Tom, because I think what we saw in April was the twin sell-off in bonds and equities really spilling very large US dollar move. I think it caught a lot of people by surprise. I mean, it leapfrogged our year-end forecast. I think it probably caused even more surprise for the dollar bears out there. But it's actually a very common phenomenon when you do see bonds and equities selling off together for the dollar to go up. So inflation's critical to the dollar outlook going forward. If inflation does start to roll over, then we could see a little bit of relief for other currencies versus the dollar.
It is not Stanley Fischer, folks. It's another Fischer from another time and place. And as you know, Elsa, there's the Fischerian linkage of all of this: interest rates, the glue, inflation, all of it, and then back over into the foreign exchange system. Can you play euro and can you play dollar and guesstimate that huge difference between the Central Bank of America and the Central Bank of Europe? Is it doable to play that?
Yeah, you know, I think it's been a driver from the start of the year, particularly given the growth revisions we've seen in the euro area and potentially more to come. You know, we started the year with a longer term, somewhat bearish outlook for euro dollar. We had penciled in 107. We've actually revised that lower to parity, so a big level there, but mindful of the risks around that. You know, what's driven that revision? Well, it's the fact that the growth outlook looks a lot weaker for Europe than it did at the start of the year. Sanctions obviously a lot harsher than I think many expected at the start of the war. And so in relative terms, there's still a US outperformance story, and let's see how long that lasts.
It seems like right now there is a floor in how low the euro can go versus the dollar. If you say getting to parity, what's the trigger, Elsa, at a time when we even have Christine Lagarde confirming that they can start possibly raising rates a couple of weeks after ending those purchases?
Absolutely. And, you know, European economists are completely on board with that view, looking for the first hike in July and then the two in the second half of the year. But I think the key is that the further you get along the rate hike cycle, the more that the role of static rates starts to matter. So it's not just about pricing in hikes, it's also about the yield differential that emerges between the US and the euro area. For me, the biggest risk is not the ECB starting to hike or doing a little bit more. It's actually something happening that derails the Fed, that causes the market to have to price out Fed hikes. That, to me, is where the big euro-dollar upside risk would lie, not from the ECB itself.
How disruptive is it, not only to the euro, but frankly to emerging market complexes, to those currencies, to have a dollar that continues to strengthen, to have this growth slowdown that perhaps is less supportive for the commodity producers that have been a haven up until now?
Look, I think, you know, EM countries in general have come a long way versus where they were in the late 90s in terms of exposure to US yields. Clearly, they still have that exposure. But what's concerning us at the moment is the growth slowdown that we're witnessing in China. I think some people put down merely to COVID lockdowns and therefore just a temporary pause in activity and one which will rebound fully. But there are plenty of signs that it's something much deeper rooted than that. If that's the case, that really leaves a lot of emerging markets exposed. That's what we're watching particularly carefully at the moment.
Elsa, a question away from the tone of the morning, and this, folks, goes back to this huge and wonderful distinction between two giants, Irving Fisher and Stanley Fischer. Elsa, let's go back to Irving Fisher and the core belief here that we had a pandemic, we threw a flood of money at it, and we're now living the consequences. How do we extricate ourselves from the obvious Irving Fisher conundrum we're in?
You know, I think it's a really interesting moment in time, Tom, because we're talking a lot about, you know, the Fed, what they're going to do. Is 75 on the table? Is it not on the table? But I think, you know, the last time I was on, Lisa made a great point around the balance sheet reduction that we're going to see. And just the fact that we've been so used to seeing balance sheet expansion in the last few years that I think that's a market environment that many are not particularly accustomed to. And that's where the pressure on asset prices come from, rather than will the Fed go 75 or 50.
How has that not been manifested yet? In other words, what do we have yet to see in terms of the consequences of that unwind in the currency complex?
I think we're beginning to see signs of it. You know, I think I was last on maybe just before the big sell-off in April. And Lisa, you and I were kind of questioning why that hadn't really happened yet in equity markets. And here we are a month later, we're seeing far greater signs of it. The currency complex less affected so far because it seems to be a parallel move. You know, had we seen some relative outperformance of European versus US equities, that might be a very different story. But for now, we're really left with the fact that sell-off. There is very consistent evidence that that's dollar positive across the board.
Also, one final quick question. There's a cottage debate right now about where Japan intervenes and, frankly, where generally nations intervene, as we saw India touch upon the other day. Does the Bank of Japan intervene at 135 or 140 and set off a global intervention against strong dollar?
You know, my colleague Adam Cole has done some really great work on this, got a good probit model of risk of Bank of Japan intervention, putting that around 30 to 35% at the moment. But I don't think intervention would have the goal or the result of reversing yen weakness, but rather smoothing it. So it's more about managing the pace of depreciation than changing course altogether.
So wonderful to get your thoughts on an important day. Anselinos there of RBC. And Bramo, you were on top of it every step of the way. It wasn't about the Fed waiting on rates so long, or for many people it was about that, but it was also about the balance sheet. Has QT even started yet?
Okay, I actually look every week, and I have seen a slight decline, but really the emphasis needs to be on slight. I mean, it's gone down marginally. It's basically plateaued. It stayed the same at $8.94 trillion from last week to this previous read. Honestly, I'm trying to understand when we actually see the material change that could trigger some sort of greater response, because this is unprecedented.
And Mike asked in the news conference, why wait until June? And I think Chairman Powell turned around and said, it's just a time, it's just a date in the diary, it doesn't matter. But for others, it was about a signal.
Yeah.
Why wait until June?
If you really are concerned about how quickly inflation is picking up, why not send a sign to Wall Street and say, we think that we need to stop, we think we need to start the unwind right now, we don't need to wait until this random date that doesn't really matter. I think that a lot of people are asking that question.
We've been talking about the FX market this morning, and good morning if you're just tuning in. Euro dollar at 105.50. Nomura out in the last day or so, looking for parity on euro dollar in the next 2 months. And here's the why from Jordan Rochester and the team. The Eurozone is more exposed to two things, more so than the United States. The Russia-Ukraine conflict, Tom, because of higher food and energy prices. And a second point, China's lockdowns with lower global growth expectations on the table. That's hitting the euro too.
Yeah, I would agree with that. And I would say that within all of this econo-babble we're doing this morning, John, the lockdown in China is the huge elephant in the room. I mean, can you imagine the difference in the debate we're having if we had that lockdown ease up? It would be a completely different discussion.
Well, Tom, to Elsa's point, though, are we just expecting that snapback in Chinese growth once the lockdowns are finished?
Yes, we
back
are.
To where we
in
were?
The zeitgeist, absolutely, 100%.
Is that the right approach to what's happening in China?
Don't know. We will know in time. Is it Jay Polanski? John, usually on with you often in one of your other properties. I think he's just been brilliant on this. China Beige Book was out the other day looking at some of the micro data. You know what? It's pretty grim. But if they get off the lockdown, things change.
Your inflation data, 1 hour and 50 minutes away in the United States. Futures going into that, the equity market with a little bit of a lift, up more than 1% on the S&P 500, on the Nasdaq 100 up by 1.5. Yields in again by 6 basis points on a 10-year to 293.24. A lift on crude up by more than 3%, 103.06. From New York City for our audience worldwide, a beautiful New York once again. Can we say that summer's slowly coming in? Bramo,
slowly.
In New York, slowly.
Slowly is the operative
Just
word.
Feeling a little bit better.
A little bit.
Day after day after day. That's what we want to see. This is Bloomberg.
Inspiring.
Is that our weather report?
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Less than 2 hours from now, we'll get the latest U.S. inflation figures. April's consumer price index is expected to show that inflation has slowed down to 8.1% year over year. Some of that decrease may be due to a drop in seasonally adjusted gasoline prices. The CPI comes out 8:30 a.m. New York time. Meanwhile, inflation in China rose faster than expected last month. The producer price index was up some 8% in April from a year ago. Meanwhile, consumer price growth accelerated to 2.1%. Virus outbreaks and higher commodity costs were blamed. European Central Bank President Christine Lagarde has joined a growing crowd of policymakers signaling a move on interest rates as soon as July. Lagarde says first rate hike in more than a decade may happen weeks after bond buying ends early next quarter. The ECB faces record inflation that is almost 4 times the bank's 2% goal. And Ukraine and Russia clashed over natural gas sent via pipelines to Europe. It is a dispute that is disrupting supplies, leaving Ukraine for the first time since the invasion. Ukraine blames the actions of Russian troops for disrupting operations. European gas prices jumped almost 7% before erasing gains. Apollo Global Management is in talks to lead preferred financing for Elon Musk's proposed takeover of Twitter. Bloomberg's learned that the funding will exceed $1 billion and is being arranged by Morgan Stanley. Traders are growing more skeptical that Musk will complete the purchase at the offer price of $54.20 per share. Twitter closed Tuesday at $47.26. Global news 24 hours a day on and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
we don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me in the second half of the year. We may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, we might be predicting, then we can adjust at that point.
This Federal Reserve, it seems, just wants to get through the summer and then reassess the whole thing. Loretta Mester there, the Cleveland Fed president, sitting down with our very own Bloomberg's Michael McKee from New York City this morning. Good morning. Inflation data at 8:30 Eastern time, so that's an hour and 42 minutes away. Futures positive 1% on the S&P, a little bit more than that, actually. The Nasdaq 100 up a little more so, up by 1.51%. Yields in again by another basis points. We're down 6 or 7 basis points to 292.46. That was the Cleveland Fed president. Governor Wallace said this. I think this quote's amazing. We have a labor market that's so hot, so overstimulated, that it's a market where you can pull back a lot of demand for labor, Tom, and it would actually be a good thing. Governor Waller, just yesterday.
Extraordinary from a public official, and I think a huge body of Americans, John, just flat out disagree with that. I understand the economics of it. We've heard it from many guests on the program, but I think for most Americans, a job and a job demand is an extremely constructive thing socially.
Haven't you found that the whole year, though, Tom, that we seem to be having a very different discussion on Wall Street to how people feel?
Absolutely.
Sitting at home. We're going to do it again at 8:30 Eastern time. We'll be talking about peak inflation. Everybody else will be talking about high gas prices, record high gas prices, Tom.
But it's
just two different worlds.
It's the same in England, right? I mean, Wall Street, Main Street here is the idea, and it's no different in any other nation, John.
Well, of course, and granted, it's the nature of what market participants have to do. They have to operate in anticipatory asset classes, Tom. They have to think about the changes in trends and all of the above and think more about the future. But the present, we've got to remember the present. For a lot of people, Tom, this is really hard stuff.
The really hard stuff, folks, is after a year ahead outlook, now July, June 30 beckons, and brave people have to do a mid-year outlook. The victim, Robert Rosner, joins us this morning, senior U.S. economist at Morgan Stanley. He and Ellen Zentner, of course, have pieced together with their team a mid-year outlook. What is a distinctive feature of your crystal ball on June 30th? What is the thing that's the greatest mystery, Robert Rosner?
Well, there's certainly a lot of moving pieces in the economic outlook. And first of all, thanks, Tom, for having me on. When we think about the broader economic outlook, what we're seeing right now is slowing growth. We've marked down our forecast for growth in the U.S. economy pretty notably from where we were at the beginning of the year. Coming into 2022, we saw real GDP growth this year above 4%. And in our latest outlook, we've cut our growth forecast for this year down to 2%. That's still above trend, and there's still some bright spots underneath. The consumer's growing a little bit stronger. CapEx remains solid, but we're seeing general moderation. And so that's point number one. And point number two is, when does inflation start to ease? We talk about peak inflation, and on a year-over-year basis, on a 12-month basis, the numbers we get later this morning are likely to show inflation moving off of that peak. The question is, how do we see that evolve going forward?
Robert, out of the textbooks, and I'm going to throw out the theory to you, and I'll let you comment. Never before, given the systemic risks out there, China lockdown, you know them all, we don't have to bore people with it. Is the inflation dynamic, the first derivative of inflation, that glide path, is it endogenous within the system, or is it shockingly exogenous because of all these outside forces?
To be honest, Tom, it's a little bit of both. The supply chain disruptions are still a very important factor driving inflation higher. We've seen that in goods prices more recently. We've seen some stalling in progress in healing supply chain bottlenecks, and that's creating what is potentially another little hump in goods prices. We may see that in the data later this morning. But then you look at the rest of what's going on with inflation, and particularly the breadth. I think the buzzword with inflation we should be talking about right now is broadening inflation and the breadth of inflationary pressures across goods and services. That is the endogenous part part to a strong economy, high labor demand, and tight labor markets.
Lisa, this is so critical, this idea of inflation embedded in the system. That is Bill Dudley's greatest fear.
And a lot of people would agree with that fear. We've seen that in markets. I want to focus, though, on the labor component of that fear and go to Chris Waller's point, as John was talking about. Do you agree with the assertion that there is so much froth, there's so much overheating in the labor market, that if you reduced some of the opportunities, it would actually net be a good thing?
Well, that's definitely a tricky one, right? Because the labor market plays so importantly to how consumers look at the economy, how confident they are to spend. So if we were to see a material turn in labor market conditions, that could enter into consumer confidence in an important way that may end up having other spillover effects. But what's absolutely right there is that inflation is a broad phenomenon. And inflation is impacting households across the income distribution, and it's impacting some more than others. Governor Brainerd or now Vice Chair Brainerd, gave a great speech about this a couple of weeks ago about how differential the impact of inflation is across the income distribution. So it's another place where we really have to slice and dice how this impacts the economy. But what the Fed is saying here is that we need to create some slack. We need to reduce demand. So the idea, sorry, go ahead.
No, there's another way to look at this, which is it better to have a near-term downturn in the economy to prevent some of the lowest income, the lowest earners in society from getting shafted in terms of how much their real incomes are in order to allow them growth later? Or is it not? Is it worth it to let things run hot and naturally correct?
It may be the case that we have to see some further slowing of the economy or even some slack opening up in the economy to bring down inflation. And so I think that gets at exactly this point, is that there may be some economic pain that we have to take in order to bring down inflation. Now, as I mentioned earlier, some of that inflation, the exogenous inflation, goods inflation, if we get supply chains healing, that may take care of itself, and that may mitigate how much of the economic pain we actually have to realize. And in our forecast, inflation does come down by next year below 3% without a recession. If that's the kind of scenario that plays out and we can avoid this pain, then we're not all the way back to 2%, but you get into a sweet spot where the Fed doesn't have to drive much economic pain in terms of raising unemployment, but allows a moderate overshoot of inflation with respect to 2%.
Hey, Rob, I know how much work goes into these pieces, this research, so thank you. Send our thanks to the team. Enjoyed the read yesterday evening. Rob Rosner there of Morgan Stanley. Just going through their work that came out yesterday evening, it's the growth story that stood out for me, Tom. As you know, you put out a forecast, the base case, and then you have the balance of risks around your forecast. And they basically said this: we think the upside is limited. I wrote the following down: because central banks globally are already trying to slow growth to tame inflation, faster growth would bring a steeper path for policy that would partially offset the upside. Something to think about going through the rest of this year.
Well, yeah, and then following on from that, Zentner and Rosner and the rest go towards a 2% inflation out there somewhere. And the raging debate here, John, is the terminal rate 4-ish, or an Adam Posen 3-ish, or the hope and prayer of a Powell 2-ish? That's the raging debate.
We're going to catch up with Dudley, who's got a, what, Tom, maybe 4, perhaps higher on Fed funds.
Bill is taking he's taking a very conventional approach.
He'll catch up with us later. From New York, this is Bloomberg.
of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed is very much setting the tone.
The Fed itself is trying to do something that they've never done before.
We are in a new regime in which inflation is likely to stabilize at high levels.
We have to get past not only the tightening of central banks, but then the impact on growth the other side.
The economy can continue to do really quite well, I think, even as interest rates rise.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Inflation data 90 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures up by 1%. TK, the data just around the corner.
The data's out there. It's going to be big headline data, yeah, top line core, and there'll be some other data, but it's the micro data that the pros are looking at. John, used cars getting a lot of press right now. Mike McKee, tell us what matters beneath the headline data.
The headline number and the makeup of that data and the price action going into it, Tom. Equities up again, yields down again for a third straight session. We've gone from 320 to 290.